It's good to see you all. I'm glad we're doing this on the Friday because if you ask anybody in my house, Friday is kind of a let loose day. It's kind of a let your hair down day. You can see how much hair I have to let down. And I'm happy to do this on a Friday because it just seems like I'm a little bit more comfortable. I'm looking up because I have all of your pictures on a monitor above me. So if I'm looking up that way and I'm looking at you, camera's looking at me. It's weird. So I'm thinking about last evening, what would Nelson open with? So as Yvonne said, this is an introduction to becoming your own banker, the infinite banking concept. And I wanted to make sure that I put this word out front and center. Nelson always talked about seceding from the current banking regime, the current financial regime, one family at a time. And Nelson's goal, Nelson's desire, uh, was to get 10%. We talked about the 10%. So I met Nelson in 1999, right when his book came out. And probably like a lot of you, like a lot of people, like a lot of agents, I did not have a fast start out of the gate. I think I got the book and it sat on the corner of a desk for probably a year until I started hearing about it from so many of my friends. I said, okay, I better start taking this more seriously. I think I flipped through it. I paged through it a couple of times. And then in 2000, 2001, I started getting serious. Now, I mean, clearly, I'm not even showing you the right book. I'm showing you the one of the second books or third books that he wrote, The Case for IBC. But if you don't have the book Becoming Your Own Banker in your hands, we'll put it in your hands. But the way I describe becoming your own banker and the book, I call it the book, is that this is an operating manual. So we're putting the operating manual in your hands. Now, if you were to take the operating manual from my truck and put it in my hands and I would read it from beginning to end, I wouldn't know the first thing about taking care of my truck. I left my truck out in the cold last week when I was away on a flight. And when I came back, the truck had been sitting out in 0 degree temperatures for 4 days and I couldn't start it. So I immediately called a couple of friends and they said, dude, it's a diesel and you have to press the button and wait a few minutes. And while they were on the phone with me, I pressed the button and I waited 7 or 8 minutes and eventually the truck just roared to life. I mean, you may get a lot out of this book when you read it the first time, but you're going to get so much more out of it when you read it the fifth time and the 10th time. And our goal in life is to have you become expert at being your own banker. Now, I'm going to make some probably sarcastic comments during the conversation about y'all being your own banker right now, because every single person on the planet who has a checking account or a savings account or a car loan, you're practicing banking in some way, shape, or form. But we want to get this treasure, this truth into the hands of people. We want to increase financial literacy. Now, it may be that if 10 times the amount of people have started reading the book, it's possible that they would do something about it. It's possible that they would change their lives. But it's more likely that the more people find out about this, the more people are going to continue to do nothing about it because they like doing what they're doing. No matter how much you listen to your friends gripe and moan about how bad their financial life is, that they're living paycheck to paycheck, that they're broke by Tuesday after they cash their check on Friday. How many people do you know really want to do something about it? And that is kind of an old saw that I keep on using, I keep on hammering on, I keep on grinding with because I'm trying to find the people. We're trying to find the 10%. who want to do something. And Nelson said the majority has never been right about anything. I hope you write that down in red, gigantic letters someplace. The majority has never been right about anything. So if you hear the majority, if you watch the majority talking about what they're doing, run the other way. I mean, we have no delusions that the infinite banking concept is going to take hold with the majority of people in this country. We're not even worried about it. We've we've been teaching this book. I've been teaching this book now for almost 25 years, and we're scratching the surface. Now, some people have really gotten a hold of it and they've taken off with it and they're teaching it to their kids and grandkids. So in their individual family, they're killing a bear. They're having fun with it. They're building wealth with it. They're protecting wealth. But I've been testing that statement. His the majority has never been right. I've been testing that and watching that and observing that in human nature, and it's been true, time and time and time again. And so, just a tiny bit of history about me. I met Nelson in 1999. Got the book, had it collect some dust for a year or so, and then I started to understand this is going to turn my life upside down. And I had already been an insurance professional, an investment professional for 24 years when I met him. So our goal is to help you become a wealth creator, and we'll make reference to that. Now, some people have read the book or they've heard the overview. They've come to one seminar and people have said to me, you know what? I wish I had met you 20 years ago because I kind of feel like it's too late for me. And I can see some of my teammates snickering when I say that. And I'll say, well, how old are you? And they'll say, well, 45. 45. No, you're not even getting started yet. I met Nelson Nash when I was 47, right? So I started when I was 47. I was already in the life insurance business a long time. So I did have a head start because I owned some cash value whole life policies. I never owned a universal life policy because universal life wasn't even invented until after I was in the business 5 years. And when it came along, I think somebody said, you know, life insurance has been around for 260 years. When universal life came along, I looked at it and said, this thing isn't even going to last. It's not even going to work. All they're doing is coming up with a cheap counterfeit a whole life. So why not stick with the authentic? And as far as people being too old, it's never too late to start. It's never too early to start. We have clients, and they are clients because they're insured. We have clients whom we started policies for when they were 2 months old. And so we have significant policies started on kids when they're 2 months old. And then we go to the other end. And I had a client who came in and started the full boat, first time owning a policy ever at age 83. So if you fall somewhere between 2 months and age 83, you could probably grasp this mathematically. You could probably put it into effect in your life. And the whole thing is going to be contingent on what you want to do with it. Let me see if I could start off with an exercise here. And Yvonne, you could just jump in and say your screen's not showing or whatever. So
All good.
let's say that you want to buy a car. Now we're going to use a very, very modest car, $30,000. And your banker calls you up and says, you know, Yvonne, I want to lend you money at 6% for 60 months. And at 60 months, you'll pay $577 a month for charging you 6%. And it's a really good deal because you're already a customer of the bank and you already have a CD, certificate of deposit, with the bank. And we're paying you 4%. So, you know, you're going to make more money on your 4% CD than we're going to make on the 6% loan. And I can't see any of you who have your cameras turned off, but I'll just ask Yvonne. Yvonne, you're my student. Uh, what do most people say when I make that offer?
Amazing.
Amazing. I'll ask them, do you agree? Do you think you're going to make more on your 4% CD than the bank makes on a 6% loan?
No.
Of course not. Why? Why? Because of one four-letter word, math, right? Math. 6% is bigger than 4%. That's my sophisticated answer. Right. So I'm going to put in my monthly payment here. Let me just copy this and paste it, put it out for 60 months. And we paid the banker $34,626. Now, during that period of time, on the right-hand side, we have that $30,000 CD growing for 60 months at 4%. Now, again, when I was tested on this equation, I had a few letters after my name. I was already in the business for decades. And I said, yep, 6% is bigger than 4%. You lose. That's not going to work. And then he hit the button. He says, wait a minute. Um, you just made $2,000 earning 2% less than the bank may. Now, that's just an example to me of the fact that everything isn't as it appears. Everything isn't true because it appears to be true or sounds to be true or because a lot of people have said it to be true. And there is a big difference. And Nelson taught us this. You'll learn this as you study. There's a big difference between rate and volume. The bank got the bigger rate. The bank got 6%. The CD owner got 4%. But the CD owner got more volume of dollars than the bank got in rate. I mean, that is just an exercise to say we need to rethink our thinking. There's one of Nelson's rules. We need to rethink our thinking. Now, the reason why we're going to have jobs for a long time as financial advisors and insurance professionals and IBC practitioners, however you describe us, is because human nature, the majority of people are buying things, investing things, starting up new businesses. Every time they need capital, they're only going to one place. They're going outside their system. You see all the places where I have stars. They're taking loans, they're taking debt. In very many cases, they're going into toxic debt to buy the things that they want to have. And very few people seem to get the idea that it might be a good idea to have capital stored up that's an increasing amount of capital as you go through life. So what happens with savings? This is my favorite whipping post, savings, right? Even a banking concept represents a life insurance policy being an amazing savings vehicle. But my parents and grandparents would say, cash is king. You want to buy something, you save up cash and you pay for it. And you've heard some talking heads on the radio or read things or watched YouTube or Instagram or whatever it is on those social media things that I don't understand. So let's look at it a different way. When I was 18 years old, I got a flyer in the mail from Chase Bank in New York, and they said, hey, you can have a credit card. Where's my pen, Yvonne? You can have a credit card. All you have to do is fill out this little Mickey Mouse piece of paper, and we'll give you a credit card for, a couple $1,000s. I thought it was amazing. And all you have to do is make your little monthly payment and be consistent. Don't be late. And we will continue to raise your credit limit. I thought this was great. I mean, I knew less than nothing about finance. And so this is what happens. The debtor goes into debt first thing out of the gate. They pay credit card back. Then they go and buy something else. They keep on going into debt and paying it back, going into debt, paying it back, going into debt, paying it back. And then the elder generation would say, that's not the way to do things. Cash is king. You need to save up the money that you need to buy the thing or make the investment or open the business. And then you spend the money, then you build that savings account up again. Now, what they should have said was you need to have more capital for 1,000 reasons every year of your life. You're going to need more capital when you're 40 than when you're 20, more capital when you're 60 than when you're 40. But what happened? At the end of the day, both of these people, the debtor and the saver, wind up in the same place. They wind up at zero. Now, one book that I recommend, in addition to Nelson's book, is a book called Second Chance by Robert Kiyosaki. And he makes a great distinction. I won't go into it right now, between savers and rich people. Between savers and rich people. You will not become a rich person by saving. But he says, this is the way rich people become rich people. This is the way they separate themselves from the pack. This is the way rich people become wealth creators. They save up capital until they can invest in something. And I'm just using a stock market account as an example. You open up a market account. I'm not endorsing this. I'm just saying this is the mechanics of it. You open a market account. Now you have stocks and bonds and mutual funds, and you can borrow against them. You can take a margin loan. Now you have two assets. You borrowed against the stock market account to go and open up the business or buy real estate or do some other alternative investment. And the market account increases and your new asset increases. Now you have two assets. Now, what's the downside of that? Not that important right now, but it's better than doing nothing. The downside is your market account could go down, and then you could have this ugly thing called a margin call. That's where your market account goes down, your broker calls you up, and you say, Yvonne, um, you've got too much borrowed out against the value of your securities. I need you to send me a check for $20,000 to keep it in balance. And Yvonne says, I don't have $20,000 separate from my market account. And the broker says, well, that's okay. We'll just sell some of your securities because we have to. Right. So there's pros and cons about having a market account and a margin loan, but the margin loan works in a similar fashion to a mortgage. Similar, not identical, but similar. You own real estate, you own a home. Your loan, as your loan goes down and you don't have capital built up elsewhere, what do people do? They go and take a home equity line of credit like good Americans because we live to be in debt, don't we? We live to make those payments. As long as we can make those payments, we're doing okay. So what's the downside? The downside is we're continuing to build up debt. And who's controlling that debt? The mortgage company. Who's controlling the margin loan debt? The brokerage company. Now, the third example I'm going to give you, which is a more ideal, I'd say optimal way of creating wealth, and we're going to go into that today, is building up an asset, building up a life insurance policy, building up a portfolio of policies. I say I'm a poster child because I'm just that bright, not that bright, so I just keep on buying more. You say, well, wait a minute, you're 72 years old and you're still buying more? Yeah, yeah. I buy them on business partners. I buy them on siblings. I buy them on my kids. I buy them on my grandkids. We're building up a generational pool of money that we all can access over time. So you're taking a loan against your life insurance policy and you're going and making that real estate investment. You're going and you're opening up that outside business. You're becoming a wealth creator. You're not being strangled by toxic debt. You're controlling the banking equation. You're controlling the asset. You're controlling the loan function. Now, I'll go through this quickly. Here's an example of an American family balance sheet. The family's making $50,000. God bless them. I don't know how a family makes makes it in life on $50,000, but they've got $71,000 of expenses and they've got $360,000 worth of debt. So my question to you is, what suggestion would you make to this family? If anybody has an idea that you want to throw at me, open up your mic and just shout it out. What would you say to this family? Okay, you're shy.
I hate to say it, Joe, but I would say you need to talk to a bankruptcy lawyer.
My next slide. I love that.
Exactly.
Hey, by the way, guys, um, I want you to understand I'm more nervous about talking to you than you are about listening to me. So don't be afraid to ask questions. All right. Yeah, the first thing you might want to do is call up those creditors and see if you could settle those things out. See if you could pay them 50 cents in the dollar. Get rid of that debt. Start from scratch, right? Unfortunately, let's look at whose family this really is. This family really has $5 trillion worth of income, $7 trillion worth of expenses, and $36 trillion worth of debt. So now you know who it is. It's us. Now you might raise your hand. You might think to yourself, well, it's not me. I don't have that much debt. You have a ton of debt. By the way, each of you personally owe $100,000 worth of this debt. That means you owe it. Your spouse owes it if you're married. Each of your kids has $100,000 worth of debt. Each of your grandkids, your cousins, your uncles, your best friend, your worst friend. Everybody in this planet, in this country owes $100,000. We all have a share of this national debt. David Walker was the Comptroller General. He was the head CPA for the country for 9 years. And he said, based on the current fiscal path, future tax rates will have to double or our country could go bankrupt. Now, many of you have seen the usdebtclock.org. I'm showing you a static version of this. If you go and watch this live, go and see usdebtclock.org, you'll see these numbers moving in real time. And you'll see that, the worst part is not the $36 trillion up here. It's more like the unfunded liability of over $100 trillion down here. Why am I saying this? Well, the first thing we need to do is maybe grab our legislators, our representatives, and demand that they get their spending under control because we gave you $5 trillion and you couldn't stay within your budget. I don't really want to hear your excuses. So David Walker is saying tax rates have to double. Look at where the tax rates have been for the last 35 years. They've been low compared to history. So we've had a tax system in this country since 1913. That's when they created the Fed. That's when they created the tax system. We've had low taxes by comparison for the last 35 years. Looking at the current balance sheet of our country, looking at where expenses are, looking how our government's spending money, you see where taxes are going. I don't have a crystal ball, but I do have some common sense. It doesn't make sense to me that taxes could go down. Now, if you believe that taxes are going to go down in the future, then you should put every dollar you could possibly put into a 401k. And I say that facetiously because I don't believe that for a second. But this is where the majority of people have their number one asset after their home, if you want to call a home an asset. Even the biggest 401k balance held by the boomers, my generation, is only $250,000. $250,000. You do the math. Could anybody here retire with $250,000 in any account whatsoever? No. And so we need to talk about just quickly where our money is stored, how our money passes through different gates, goes into different buckets. Savings and CDs and stocks and bonds, they produce taxable income, which is taxable today. Tax deferred vehicles, and I think there are a lot of reasons why these should be questioned very seriously. I mean, you're like setting up an account for the government's benefit. You're setting up money that the government can absolutely identify and tap into if they need to, even though they said they wouldn't. If there's one thing I've found out about government is they do change their mind on occasion. Then there's the tax-free bucket, which very few people pay much attention to because the tax-free bucket includes Roth IRA. How many people don't know? You can put your money into a 401k, but make sure you designate it Roth 401k. Virtually every 401k has a Roth component, a Roth bucket. Mutual funds, if you buy the municipal funds, municipal bonds in the state in which you live, they'll be tax free under certain conditions. And cash value life insurance. So let's talk about the ideal savings tool. And I'm looking at the clock and I'm going to run out of time. So the ideal savings tool, let's just assume that you agree that the ideal savings tool would have these and probably other features. You'd want to have a competitive rate of return. You'd want it to be guaranteed or have some kind of guarantees built in. You'd want there to be liquidity. I want to be able to get to the money when I need to. You'd like it to be tax free. You'd like it to be creditor protected. If I get sued, I don't want people touching my money. And you'd like to have uninterrupted compounding. Now, if you look at a 401k and find out whether the 401k meets those qualities, meets those requirements, you'll find that it doesn't have uninterrupted compounding because it does go backwards. You do have market volatility, market fluctuation. You don't have guarantees. In fact, I ask people all the time, do you have any expectation of what your 401k is going to look like on the day you retire? No, because the market goes up and down. Can you tell me how much money you've put into your 401k as of today? Most people would say, no, I really don't know how much I've put in, but I know how much is there. Well, in order for you to find out whether you have a gain, shouldn't you know how much you've put in? Okay. Talk about that another time. Savings account. How many of these qualities does a savings account obtain? Well, you don't get a competitive rate of return. You don't get tax free. You don't even get credit protection. Your savings account is fair game to any creditor who gets a judgment against you. They can go to your bank tomorrow, and I don't know if this is true in every state, just most of the states that I'm familiar with, and they can get your money out of your account before you wake up in the morning. Then if you look at a specially designed life insurance policy, the way we've been building them for the last 25 years, you're going to see all these benefits and more. I mean, there is a reason to investigate it further, even for no other reason. Now, again, I'm going to whip through these things. Every one of these qualities really deserves additional conversation. I mean, how much collateral do you want to own? How much money do you want to have access to during your lifetime? Well, having an asset that has collateral value without all the negatives is something that my higher earning clients, my lower earning clients, wage earners, business owners, professional people all agree. Yeah, I want to have an increasing pool of money that's got guaranteed growth, that's not market correlated, that's not going to go up and down with the stock market, that's protected against creditors, that's free of probate. I shouldn't have to go through some fancy trust and estate program with my lawyer to direct this money to whom I want it to go. Got legacy value. I can create generational wealth without a lot of chaos or complexity. I can make unlimited contributions. I still have not run out of people I can insure, even though I get to own the policy. Living benefits, chronic illness, critical illness, terminal illness, there are additional benefits over the top. And this is just a summary of all those things. Now, the Bauer report, the Bauer company is somebody that we really rely on. It's a third party. They analyze banks and credit unions very carefully. And they'll produce a report on every single bank and credit union. And they tell us how much this bank has on deposit, how much they're gaining in value, how much they're paying us. And we refresh these numbers periodically. And all we know very consistently, and that all of these numbers do, is they continue to go up. So we're going to continue to talk about the model, which is the saver, the banker, the borrower. What I want to continue to hammer on is that by becoming your own banker, you're taking the banker out of the central position and you're putting the banker, which for us is no longer a commercial bank, but it's a life insurance company. You're putting that life insurance company in a lesser position, not in the position of control, but you become the person who's in the position of control. Excuse me. So in the year that we looked at, 2017, all the numbers have done was gone bigger and crazier. At the time, Bank of America had $900 billion of our money in savings accounts. So we go down to the bank, we make deposits, the bank holds the money without getting into a long dissertation on where the money goes. The banks only do one thing to it. They lend it back to us. They lend it back to the savers. They lend it out to business owners. They lend it out to people who are buying houses, taking SBA loans, buying cars, buying trucks, building out their business. It's funny that we get such a menial interest rate from any bank you can think of. And in this case, Bank of America paid its depositors $3.1 billion, and we'll do the math in a second, $3.1 billion on $900 billion in deposits. But those same people who made those deposits, and probably others as well, because banks like to lend money to bank customers. You'll get preference if you're a bank customer, right? So Bank of America collected $50 billion from us. And all they really did was play the role of the middleman. They took our money, they packaged it up, they marked it up, and they lent it back to us. That's what they did. And so they paid us about 1/3 of 1%, and they collected 5.5%. So you might say, well, any company deserves to earn a profit. Absolutely deserves to earn a profit. But how much money does Bank of America have of their own money in this mix? It's Zippo, zero. Nothing. So when you look at the ratio, for every dollar that they paid us, we paid them $16. Now, there are some things that Bank of America does that banks do that we cannot do. One of them is fractional reserve banking. All that says is banks can lend out more money than they actually have. They can lend out money fractionally. They can lend out invisible, hypothetical money. Now, you and I are not allowed to do this. If we were to write a check on money that's not there, we bounce the check, we get charged a fee from the bank. We've got to restore the value that we overspent, right? That we overdrew. It doesn't work for us. There used to be a time when the banks had to maintain a certain margin. Up till about 2022, I believe it was about 5%. They had to have a margin that they couldn't lend out. They couldn't go over a certain limit. In 2022, the Fed lifted that margin. It's now zero. There's a zero margin requirement. Banks can turn that money faster and faster. What's another thing that banks do? Let me say this second. Banks have the benefit of advertising FDIC. Now, you might think that's a good thing. What people don't know is FDIC reserves cover about 0.7% of all the money that's in savings accounts in this country. Take Silicon Valley Bank that went bankrupt about 3 years ago in California. They were worth about $200 billion. $200 billion disappeared. Only 10% of that 200 billion was covered by FDIC insurance because most of those accounts exceeded $250,000. Your FDIC insurance only goes to $250,000, but most people don't know it's a house of cards because they're only covering less than 1% of all the savings. They have a penny of reserve to cover a dollar. Now, the third thing that banks own is called bank-owned life insurance. Banks buy tons and tons of life insurance. This Bank of America that we're talking about has $24 billion of cash value inside the same kind of life insurance policies that we help our clients build. Now, it's interesting to me, Bank of America thinks so highly of cash value life insurance, and so do 4,000 other banks in this country, by the way, that Bank of America has more cash value in life insurance than they own real estate. They have more cash value in life insurance than they have in their defined benefit pension plan. And here we are buying into the fiction that we should pay cash and therefore avoid the cost. But Nelson taught us you finance everything you buy. You either pay interest to somebody else or you give up the interest you could have earned when you pay cash. So when you pay cash, you're still losing money. You don't see the cost, but there is a cost. So we're either using velocity or we're using it. These are some examples, and there are thousands of examples. Every single Fortune 500 company owns life insurance on its key executives. That life insurance that Bank of America owns does not benefit the customer, doesn't benefit the saver, doesn't benefit the stockholder. It benefits the internal employees, the personnel, especially the balance sheet of that bank. And you may have heard this. Walt Disney borrowed money against his life insurance policy to start Disneyland. Ray Kroc borrowed money against his life insurance policy to invest in McDonald's. His name is Kroc. It's not McDonald's. He bought out the McDonald's brothers because they didn't want to expand. It seems like everybody knows about this except the people who should know about it. The people who are earning paychecks, who are raising families, who would love to build generational wealth. Here's an example, because again, I'm watching the clock. I'm trying to honor the time here. Here's an example. As I said, I was a little bit of a knucklehead. I was a little bit slow in the uptake.
You're okay, Joe. Take your time. It's okay.
Thank you. I was a little bit slow in the uptake. In 2003, we decided to use the infinite banking concept model to finance our next car. Now, since 2003, I have never taken a car loan. And I got to say, using your banking system to finance the cars for the rest of your life will make you money. But this is only beginning. This is just the surface, right? So we used our banking system. And I'm not going to show too much of this. I went to my wife and I said, honey, can you see me circling 12% there? The insurance company wanted to lend me money at 5. And I said, if a little bit is good, then a lot of it is better. So the insurance company's going to lend us money, babe, at 5%. So what we're going to do is we're going to set up a loan at 12%. And she said, you're crazy. But I said, here's the way it's going to work. We're going to pay them back, the insurance company. Notice I've taken the insurance company, the bank, out of the middle of the equation because now they serve a lesser position. They serve at the behest of the owner of the banking system, which is me, which is my family. I said, we're going to pay them the 5% that I owe them in interest. I borrowed 42,000. I charged my wife, who manages our books, 12%. I paid $11,000 of extra interest. Where do you guess that money went? It went into my policies to continue to build up cash value, continue to build up more life insurance, continue to build up other benefits. And now, when you look at the benefits that we built up, I paid back the $42,000. I paid in extra interest. I got a tax deduction only for the 5% that the insurance company charged me. And I got salvage value of the vehicle because I controlled it. So I bought a $42,000 car, and at the end of 6 years, I controlled $75,000. I mean, this is not smoke and mirrors. I'll tell you what's smoke and mirrors. What's smoke and mirrors is your banker telling you that you're getting a great rate. You know, while that banker is collecting that 577 and 10 cents per month, guess what they're doing with it? They're throwing it back in the banking system and they're lending it again. They're not practicing compound interest. They're practicing velocity. Now, this is an extension. And now remember, we talk about three positions here. If you're going to be an entrepreneur, if you're going to be a business owner, if you're going to be your own banker, if you're going to control wealth, if you're going to build wealth conservatively, guaranteed so that it never goes backwards. And I'm going to remind us what Nelson said. A life insurance policy is a financial tool that gets better and better the longer you have it. And there's nothing you could ever do about it. You cannot lose money. It's the only financial tool. I'll make that statement a little bit broader. It's the only tool, financial tool on the planet that is guaranteed to increase in value every year you have it up till your graduation, up till age, let's say 120, because life insurance policies are calculated to age 120. And so I want to control these positions. You Many of you may have more companies, maybe you have no companies, but controlling the money is the name of the game. So this is my financial model, and I've put money into all of these investments, and there are some alternatives that I haven't listed, private investments that I've made in companies. But I've been able to do that because on the left-hand side, what you see is one, two, three, four, five, six. What you see is six policies that represents the dozens and dozens of policies that I've built up over time. So it's important to me that my clients get the foundation, that they understand why. Why would I want to control my own banking? Well, because someone else is controlling it now. Why would I want to build up an increasing pool of money that I can never outgrow or outlive, that I'll keep on adding to it and controlling every single year? Because the alternative is using debt. The alternative is getting deeper into toxic debt, into mortgage debt, into SBA debt. The alternative is building up the cash and then spending it, and then you're spending the seed corn and starting over again. Now you're building up multiple assets and creating the velocity that the banks teach us is a good thing to have. Now, by the way, you've probably never seen a billboard where a bank says, "Hey, come and open up an account with us because we're going to take some of your money and buy life insurance with it." Now, over the years, I've laid this out for clients, and some of them has said, "You know what? Call me stupid, but wouldn't I just want to take my money and go direct to the source? If the bank is taking my money and buying life insurance with some of it, and they're benefiting and I'm not, why wouldn't I just go and create a capital account and buy insurance for myself and have it work the same way, only I would benefit instead of the banker?" And I say, exactly. Now, here are some references. And if you read Nelson's book, you're going to find out that he's got about 3 pages of recommended reading. This is just a little bit. We've got the law. If you'd like to read the law, we can send you an ebook. It's only about a 50 or 60 page book that Frederick Bastiat wrote. He was a French economist, wrote the book in 1850. And what he described is the system that's going on in America today. He was prophetic in that sense. The system that's going on today, where we're grabbing, the government is grabbing money from those who are producing and redistributing it to those who are not producing. And Frederick Bastiat called that legal plunder. I think it's a good foundation. I think every single person, in fact, Nelson Nash, a greater authority than I am, said that if you could only read 10 books in your life, the law should be one of them. So just on that basis, if you'd like to read the book, we'll send you the ebook. Down in the lower middle, life insurance as an asset class. I'm happy to send that as an ebook to anybody who wants to read it. If you have trouble sleeping at night, it will absolutely put you out. I send that to folks who are analytical or who think that they're analytical. Maybe after they get finished reading that book, they're not so analytical. And the last thing I would say is what Nelson called us to do. One of the many truths that he taught us was we need to rethink our thinking. I talk about silo thinking all the time. You're setting up one system over here. Well, this 401k is going to serve a certain purpose. But yeah, that money may be getting stale while it's growing or not growing in your 401k because you have no access to it. You have no control of it. You don't know what the tax structure is going to be in the future. You don't know if you're going to be in a lower tax bracket. You don't know if the market account is going to make more money. You really don't know if it's going to do any part of the job you think it's going to do. And you're talking to somebody who has set up 401k plans for clients. I do know them from the inside and the outside. I'm not saying they're a totally bad thing. I'm just saying you should take them with a grain of salt and look under the hood before you dive in and put your whole life savings into those things. Rethink your thinking. Let's open it up, if you like,
Yes,
for questions before we go into the next section.
absolutely. Yeah, we actually have some questions. We have quite a few questions in the chat here. I'm not sure. Oh, I
Can
think.
you get closer? Ashley, we're having a hard time
Oh,
listening,
I'm sorry.
hearing you.
I'm sorry. Can you hear me now?
Yes.
Yep.
Okay. Sorry about that, guys. Yeah, we have they all sent the questions to me. So the first question is, we have, what are the steps to take out a life insurance policy on a key employee?
Okay. Well, that was a setup question because I do a lot of that. So a person who is the business owner is the applicant, is the owner of the policy, is the payer of the policy, is the beneficiary of the policy. So the owner, the business owner, controls that policy. That asset belongs to the business owner. So the business owner would go to the key person and say, "Hey, you're really valuable to me, and if something were to happen to you, this company would lose money. We'd actually lose profits. We'd lose gross revenue, maybe even lose some customers. We would lose some momentum. So I'd like to buy a policy on you." The employee needs to agree in writing. The employee needs to sign the application as the insured. The employee needs to get examined. The employee signs a separate form that the IRS requires that says, "I acknowledge that I'm an employee and that my employer is taking a policy out on me." This is something that, like I said, Bank of America's got $24 billion worth of this stuff. And to be brutally honest about it, if you want to continue to work here, we have a right to insure you. Now, it may be at some point in the future, we may enter into a separate contract that gives you some benefit the longer you're here for tenure. We may enter into a contract that says, if something happens to you, I will pay a benefit to your family, your heirs, your beneficiaries, your spouse, etc. Those are separate things, but the process is we get the owner to understand, sign the application, get the employee to agree to submit to the underwriting, get examined. And once the employee is examined and approved, Everything going forward is all under the direction of the owner, which is the business owner. Does that help?
That came from Jonathan Hyman. John, I'm not sure if you can. Okay, okay, cool. All right, and then the next one we have, well, she says she doesn't know if now is the time, but she would like to understand the car loan situation a little bit deeper or clearer. So that may be more of like a one-to-one kind of
Yeah, well,
thing.
just let me just lay this out. All right. And if the person who asked the question would like to have a back and forth Q&A, just quickly, um, how are you paying for your cars now? You're either paying cash or you're financing them. In each of those cases, at the end of any given period, you don't have the money, somebody else does, right? Using the banking concept, you're setting up your capital account, you're setting up your policy. And even if in the early going, you can't finance a car right away, maybe you could finance a good chunk of it more quickly through your own policy. And maybe you've only got to get a bank loan for half of it. Make sure you get a bank loan that does not have a prepayment penalty. But ultimately, one of the things that we want to do in becoming your own banker is you want to control the banking function, which means you want to recapture debt. So as soon as possible, I want to take that $30,000 loan away from the bank and I want to put it into my family system. I want to transfer that loan to my system, borrow money at 4% or 5%, depending on how old your policies are. So I can control that equation. I mean, at the end of the day, your policy loan is only interest only. You're paying principal back when you want, if you want, and as you want. So yeah, your advisor who will invite you can get into more details, show you a spreadsheet, show you the dollars and cents going in. But control and freedom is going to be a lot more enjoyable and feel really great when you start to do this.
Cool. And then, oh, I think we already answered your question, Jonathan. He was asking about how about a key employee at a church? Is that any different as far as owning a policy out on them?
Nope, we've set up key policies, key man policies, key person policies for church employees. Typically, the business manager of a church, the head of the Christian school. In my case, I set up policies. The youth pastor, associate pastor, and the church owns the policies and uses them in the same way that a secular organization would use them, that a bank would use them, that my company would use them. So the bank adds those policies to their balance sheet, and they've got access to the money um, just as any other business would.
Cool. Those were all the questions inside the chat. Does everybody have the ability to unmute and ask questions too? I just want to make sure. I think everybody.
Yeah, actually, can you guys hear me?
Yep.
Yes.
Yeah, so Joe, great presentation. I actually had a whole life policy, and you said like, oh, you can't lose money. Northwestern Mutual, my quote unquote advisor, told me the same thing. But 7 years into the policy, I couldn't keep up with the payments, and I was in $31,000 of credit card debt.
Hmm.
And then when I looked at my options, they said I had lost money. I was like, what the heck? And
Okay.
apparently, there's a thing called cost basis, where the premiums, I was paying $1,000 of premiums, and paying myself, like you said, but those premiums, the cash value was 130,000, and my cost basis, I had no idea what cost basis was, 180. So I had a $50,000 loss. And like, so, what the heck? Like you said, you
Yeah.
don't lose money. Northwestern Mutual said you don't lose money, but I lost money. And
Sure.
apparently the illustration had hundreds of thousands of dollars, but I didn't know how to interpret it. But on the illustration, which was kind of complicated, it said I wasn't going to be, I wasn't even going to break even until 15 years in this stupid policy. Like what, and so,
I'm with you. So here's
you do lose money, like, right? Like, or was Northwestern Mutual like just a terrible, like
no,
company? Like maybe they're
no,
trying to
no, it's
profit off me.
not a terrible
Yeah.
company. The policy wasn't designed the way we would design them. So a couple of comments. Number one, before I met Nelson, I built my policies the way they told me to. So my cash value was not great. It was close to zero in the first couple of years. Your policy may have been built that way. Now, the thing is, the policies that I bought when I was first in the business were 20 years old by the time I met Nelson. So even though they had poor cash value in the early years, because I stuck with it, those I still have those policies today. Those policies are 40 years old. And the only bad thing about those policies is they were too small, right? So if you will keep a policy for its intended length of time, which is until the day you graduate, you're going to be fine. And I should have said it this way: if you keep a policy to maturity, to endowment, to fruition, you're not going to lose money. When we build our policies, typically 99% of the time, our policies break even, and I mean break even, in 7 years. So you put in 100,000 in 7 years, you've got 100,000 in cash value. Individual situations are different. Northwestern's not a bad company. It's got some negatives, but maybe your policy wasn't built for equity. It was built for death benefit. So we focus on building policies to create 50, 60% equity in year number one. If they're not built that way, it's going to take a longer time to break even. Is that policy, if hypothetically, would that policy still be worth keeping? Absolutely. Because if you keep it to 15 years, 20 years, you're going to continue to need finance in your entire life. It's not a bad policy. Maybe it could have been resurrected or rehabilitated. And that's one of the things that we like to do is I like to help clients keep and rehab their existing policies because those policies are worth their weight in gold because you bought it when you were 7 years younger. So yeah, you can lose money if you start something and drop it tomorrow, for sure.
Cool. Awesome. And then we got a few more questions inside the chat too. This one is there any reason why I would take out a policy loan using non-direct recognition? I think that's what it's called.
Yeah, non-direct recognition is, I think, an ideal way to do things. Our policies have both options. Non-direct recognition means your policy will continue to grow regardless of whether you have a loan against it or not, just like your house. Your house appreciates regardless of whether you have a loan against it, right? Your house doesn't know that there's a mortgage, right? With non-direct recognition, your policy doesn't know that there's a loan against it. So the values grow just as if there was no loan. Now, the direct recognition method is where the insurance company will actually give you a lower dividend on policies that have loans against them. But there's a benefit to that as well. One system, and we have both, and you can pivot back and forth in our policies, which is really cool. So you can decide this year you want to use direct recognition. Next year you want to use non-direct. It all depends on whether the dividends are high or dividends are low. So again, we can get into that, but regardless of what kind of a policy you have, the fact of whether your individual policy that's in existence is direct or non-direct, we can show you how to get the best advantage of it. But the answer is yes, you do want to take loans, especially to get rid of outside debt that you would just as soon get rid of.
All right, cool. We got just a couple more questions. And then this one is to piggyback on a business question. Can an owner of a business get a life insurance, get life insurance on themselves? And also, why do you need to send a form to the IRS when you do not have to pay taxes on the money?
I don't know what form you're referring to.
Yeah, that comes
Yeah,
from.
no, we're not. Oh, the form I mentioned earlier, you're not sending that form to the IRS. You're having the employee sign an acknowledgement that they're not being fooled into applying for a policy. It's a form that you keep in your records and the agent keeps in our records so that if anybody ever comes back and questions, did this employee actually go into this contract with his or her eyes open, or were they forced to? No, that's just a form that acknowledges we had the employee's permission. We don't submit it to the IRS. The other question was on the owner. What was that?
Yes.
There were two questions there.
I think it was kind of one, unless you want to clarify on that. But it was just, can an owner of a business get life insurance on their self?
Sure.
Yeah,
Sure.
absolutely.
Yeah. So there are two. We actually can buy policies twice. I can buy policies on myself to cover myself personally to protect my family. My business can buy a policy on me with a separate tranche of coverage, so I can get another 10 times my income as a key person policy. So we often use both methods to almost, in a sense, double up coverage for clients who want to get maximum coverage.
Cool. Perfect. And then we have just one more question. It says here, I have a question about existing term policies. Any use for those there?
Any news?
Any use? Any use?
Oh, any use. So I love term insurance. I especially love term insurance to give you maximum protection. God forbid something happens tomorrow. Most people would like their family to continue to receive their income 100%. If I'm making $100,000 a year, how much does my wife want to continue to earn? $100,000. Therefore, take as much life insurance as the company will give you. Well, I can't afford $3 million worth of whole life. Fine. Then buy $500,000 worth of whole life and $2.5 million worth of term. We want that term to be convertible term. We want it to be with a mutual company that has a great whole life policy. You buy some term policy because it's cheap online or with Banner Life or something. It's convertible to a policy that is only for the purpose of that company's conversions. They don't intend to convert policies. They convert them by force because they have to. And those policies you can convert to are super, super ugly. You wouldn't want to own the policies that they are willing to convert to. So you want to buy a term policy with a whole life company so that you can convert to that whole life.
Yeah, and this is actually great, Joe, because the next section that I'm going to go over is building a whole life contract. So I'm going to do a quick little class on what is a whole life, how is it supposed to be built, what's the difference between a death benefit contract versus a cash accumulation contract, right? And hopefully by the time, and this, by the way, is the vehicle, right? We're gonna learn about the vehicle itself. The policies are not your banking system, right? You are your own banking system. You just need to make sure that you are building well-designed policies, that you are buying these policies from advisors that are knowledgeable on how to build them, and understand how each and every one of those are funded and how every dollar that comes into these policies is moving every time that you make a deposit. And I use the word deposit. I never use the word premiums. Premiums are something that is a debt. Premium it's a purchase. If you're going to become your own banker, you're going to designate a series of policies that are going to be a depository system, right? That's where you're cash flowing your dollars through. You have to put your banker hat on and talk in terms of being a banker. A banker meaning deposits, right? We're going to look at a difference between, and I see a question here from Ricky. We're going to talk about a whole life contract, and I'm going to compare it to a contract that is an IUL, an index universal life or universal life, right? You cannot use products that are not guaranteed. So let me get started with my presentation here. And I think, Ricky, by the time we get done with learning about life insurance, I think you'll see, hold on a second. Let me just share the right screen. Hold on. I have so many screens, you guys, that.
I'll keep you on track.
Thank you, honey. Let me know. Did you see the
Yes.
PowerPoint? Okay, thank
Yes,
you.
yes.
And today we're going to focus on whole life, right? There is no other policy that can be used to create your banking systems other than a whole life contract. And if you are talking to advisors out there, and we hear them and see them all day long, selling you, talking to you about index universal lives or variable universal lives, then they don't know what they're doing. Be very careful, because anyone can make any illustration look amazing, right? When there's variables involved, index markets, market correlation. But the reality is that a whole life contract, and I'm going to give you a little bit of a background of how whole life started. Let me just move this forward here, right? Here's the history, right? Life insurance has been around. I mean, look at the first date here, 700 BC, right? And through all the years, that people have talked about the importance of, and I'm talking from a death benefit standpoint, right? Of the importance of owning life insurance. And by the way, your banking policies are not your death benefit options, right? They're not your death benefit policies. Not only should you have banking build policies, but you should also make sure that you have death benefit build policies so that you can protect your most important asset, which is what? Your income, right? Something were to happen to you, it's great to have a bunch of banking policies, but do you have enough death benefit, enough life insurance to take care of your family, to take care of your business continuation? And that's a discussion when you meet with your individual advisors that we're going to have. Okay. But when you look at the history of life insurance and you look at the number of years and the number of ways that it has moved, and even, you think about a vehicle that's been around for centuries. How many things can you say have been around this long? So we're talking about a very old and very, I hate to say the word boring, but it is a boring product. Very steady. It's not exciting. It's long, but because of its steadiness, it works well for you to be able to manage and create this guaranteed pool of cash that you're going to be able to access. Let's talk about the different kinds of life insurances that are out there, because not all life insurance are the same. And I know that many people, when they think about life insurance, you go term, you go permanent, right? There's a lot of advisors that say a lot of things, but here's the simple part. A term policy is like renting an apartment. It builds no value. It's extremely cheap, high death benefit insurance. Does term have a place in a portfolio? Of course it does, right? Maybe there's a mortgage, maybe there's a loan, maybe there's a buy-sell agreement on a short period of time. There is a space. And maybe financially, you can only start buying term before you can start converting them into banking policies like Joe was talking about. But when we talk about permanent policy, you have the variable universal, you have the index whole life, you have the universal, and then we have whole life. And in our world, in our company, we build our systems through use of whole life policies only. And I'm going to show you kind of how we build them and why we build them the way that we do. The first thing, and Joe kind of alluded to this, is the very first thing you have to think about when you're choosing which company to start dealing with. There is a stock company and mutual companies, right? When you look at a stock company, stock companies are owned by stockholders. Profits go to stockholders. They're non-participating policies, and the stock dividends are taxable. So when you're doing your research and you're looking at how am I going to build these things, the first thing that you have to think about is this a mutual company? We only work with mutual companies that are owned by policyholders, companies that profits go to policyholders, and companies that the policy dividends are non-taxed. Now, I want you to think about, what I mean when I say think about which company, because technically when you're building these policies, you're hiring this life insurance company, right? They're going to be the managers of these contracts that you're going to be managing. You have to make sure that they have the ability and that they are, and by the way, that's what we're here for, right? We only contract ourselves with the companies that we know are friendly to doing what? Being able to have access to this cash, being able to build the policies, fund the policies properly. So I think it was Ricky, when you were talking about Northwestern Mutual, interestingly enough, I was a Northwestern Mutual agent when I started back in 1991. That was my very first job out of college. And I worked for Northwestern Mutual for a number of years. And I will tell you that Northwestern Mutual is a life insurance company, but focused on life insurance death benefit. I can guarantee you that the policy that was built for you was built with a death benefit component versus a cash accumulation component. And as I go through it, I'm going to continue to say those words, right? I want you to, as I teach you how deposits work inside of a policy, as we're moving dollars inside of the policy, we're either focusing on death benefit or we're focusing on cash accumulation. So let's take a look and see how you would fund the policy. Now we are here with the mutual company, right? Because that's what we have to do. And I'm going to give you an example of, let's say that we're going to buy a $500,000 life insurance death benefit policy. And I say it this way because this is what most of my clients always have in their mind when they think of a life insurance. They ask me questions like, how much does it cost for $500,000? How much is the price for a policy for 250, right? When you're buying a death benefit policy, okay, that's a discussion what we have to have. But when we're funding IBC policies, the death benefit is whatever it needs to be to help us deposit the amount of dollars that you want to be in. So our discussions are going to be with, you tell me what your budget, what your budget is. What is your deposits? What is your commitment to start building this? And in a little bit after me, Curtis May from Practical Wealth is going to talk about finding that money, right? How am I going to fund these? But when you look at the actual whole life contract, there's a minimum and there's a maximum of every cost of any death benefit inside of these policies. And the government sets the maximum rate that you can pay for that 500,000, and the insurance company gives you the minimum. So there's a corridor, right? If I say to you, well, I'll tell you what, you can put in, and let's talk about what I mean by, before I tell you about putting in, when I talk about the maximum. In the 80s, of course, the government comes in and says, wait a minute, there's an awful lot of cash value being built inside of these policies. Prior to the 80s, there was really no MEC rules, right? We are now going to put a cap on how much you can put in before the IRS steps in and says, now these are going to be a taxable event. So the corridor that we always look when we're building IBC policies is to make sure that these policies don't ever cross this line. Because if they become a modified endowment contract, if they cross this line, then the government's going to treat these policies like an IRA or 401k. You may have to pay taxes. You may have to have a 10% penalty if you touch a prior. They take on a qualified plan kind of mode, right? So you're going to hear when you talk to your advisors a lot about MEC. And this is why sometimes, depending on fundings, we have to build a multitude of policies. You get to the point where you fund one to the highest level, and now you can, if you put one more dollar, now it's time to start policy 2, maybe policy 3. And that's when Joe talks about looking at business partners, looking at key employees, at family members, at anyone that you have an insurable interest. So as we build the policies for you and as we look at this corridor, right, it's the same death benefit. Am I going to pay $500, right? By the way, look, I put this down here because I heard this, one of our mentors talked about this. The fact that the federal government limits how much money one can put in life insurance is what? That it must be good, right? Because they only tax things that are good for them. So let's assume that you could pay $1,000 for this policy, or you can pay, right, the minimum. Let's say it's just $1,000. That's all I want to pay. Then you are now at the bottom of the contract for that 500, and that becomes a term policy. Most people are going to think about these IBC policies in terms of cost. It's not about the cost. It's about how the funding goes into the policy. Because on a well-designed contract, what you want to do is you want to make it as efficient and as close to this MEC line as you possibly can. The $500,000 continues to be the same, right? For the death benefit in this example. The question is are we going to deposit 1,000 or are we going to deposit 10,000? And how is that deposit going to look as every year you're funding it in? When does it start cash flowing? And I think, Ricky, that was what you were talking about. Year 7, you put all this money in and it's not even cash flowing. It's still under, because that is a life insurance death benefit driven contract. So as you're thinking about, when you talk to your advisors and they say to you, tell me how much you want to deposit, right? What we're looking for is this corridor. How are we going to design it so that it's maximum efficiency closer to that MEC line, right? And be able to give you the tax invisibility, but also maximum access to putting dollars into the cash value side. And let's look at what I mean by that. By the way, aside from all of this, right? Here are the benefits that Joe talked about. Having a well-designed policy also carries all of the death benefit features of a life insurance contract, right? Let me go to the actual policy design. 99.9% of traditional life insurance agents that sell life insurance as a death benefit will put 100% of the deposits or premiums that you pay into the cost of the death benefit. So if you have someone, for example, that says, hey, here's $10,000, I'm going to put it in and I put it all towards the death benefit, that can buy you millions of dollars of whole life death insurance. Cash value being very low. Joe made a reference earlier in his when he was talking about policies that in the first couple of years have zero cash value. That's when you know that an advisor has put in most of the dollars going in into the death benefit component. When we look at an IBC model, our model is a blended model using a rider available in whole life contracts called a PUA, paid up additions rider. It's a rider that allows you to add additional dollars into the cash value component of a whole life contract. So we minimize what you see here at the base. You see where it was 100% on the left side. We're going to lower the cost of that base, and we're going to maximize the cost of putting dollars into that accumulation. And Ricky, this is where maybe your Northwestern Mutual policy failed you. It was probably not blended enough to create a positive flow earlier on to the contract. And I'm going to show you an example showing you some numbers, because I think it's important to see at the end of the day, we build these policies for one thing and one thing only: cash flow. How quickly, how much dollars do I have to put in and for how long to grow the dollars that are within, what my plan is. And if you look at this example, same example as the one that I showed you earlier, $10,000 going in, I am going to split that between a 4,000 base premium and a 6,000 paid up additions premium, which, by the way, I can take that 10,000 and I can put in 5 and 5. I can put, right, 6 and 4. I can do all 10 into the death benefit. This is where working with a seasoned and trained IBC specialist, like, everyone that has invited you here, is important, because not everybody knows how to make this blend. Not everybody knows exactly how to divide these dollars to make it efficient. If you look in year one, you'll see the $10,000 deposit and the cash value increased by $6,187. And so many people say to me, well, I lost money year one, right? What you have to understand is just like any business that you build, right? When you're building these policies, it's almost like a franchise. There has to be operating costs that has to be assessed while you're building this. You're hiring an insurance company to manage that for you. You're hiring an insurance company to insure you for a death benefit in case something happens. You're hiring an insurance company to give you access and liquidity and a process of loaning and repayment back. So there's a cost associated that you will incur in year one. I want to point out that for this $10,000 deposit, you will see that the base death benefit that we will need in order for it to be at that MEC level, remember the corridor, is $234,132. That's the amount of death benefit that I need for a 40-year-old female, because I have to make it a female for all my girls out there, right? In order to accommodate a $10,000 deposit. So year one, I put in 10,000. I put it 6,187 available. My death benefit went up to 256, 213, taking in consideration the additional PUA that I'm putting in. Now we get to year two. In year two, I add another 10,000. And by the way, some people put additional dump-ins straight into the PUA above and beyond. I could say I have an additional $10,000. I want to pay off my car. I'll do a dump-in, take out the 10 right away, go pay off my car, repay myself back with interest, right? And that would be a model that we can look at also. The second year, I'm going to put in the 10,000. Now my cash flowing by 9,634. That's pretty darn close to that 10,000. So my $277,000 of death benefit has cost me how much? 300 and some dollars, right? Because I put in 10 and now my policy grew by 9. By year 3 in this scenario, we put in another 10,000. Now we're at 9,575. Again, the cost of this policy, the cost of the death benefit, the cost of hiring the insurance company is assumed those first 3 years, mostly in that first year. In this scenario, by year 4, now this is policies cash flowing. What does that mean? For every dollar that I put in, my cash, it grows at a higher number. So I put in $10,000 year 1. In year 4, I now have a cash flow of 10,138. The next year, I put in 10,000, and now my cash value grows by 709. By the way, you can see the cash surrender value, right? Every year just continues to add itself. I could say 5 years from now, I'm going to go buy a car. I'm going to take this $46,000 that is sitting right here, and I'm going to purchase a vehicle and then pay myself with interest. Or maybe not, right? It's your banking system. Now, I can also say, all right, this is cash flowing. I'm going to stop putting in the 6,000. I'm going to just put the minimum. The minimum of any whole life contract is that base premium, that 4,000 that I have to maintain the death benefit. You have to maintain that. The minute you remove the death benefit of the equation, it's no longer tax invisible, right? But I don't care, because for every time that I put in my base of $4,000, my policy grows by $5,495. How many of these would you like to have that today you put in 4,000 and tomorrow you just grew by $1,400? As many as possible, right? Because as Joe was saying, as the years go by and you continue to deposit, the policy just gets better and better and better. And in year 11, you put in 4,000 and it grows by 7,205. Death benefit continues to grow. By the way, you take that other 6,000 that you were doing before and you open policy number 2 and you build policy number 2. You fund that until it's efficient. Maybe you then do policy 3. This is how you build and you layer these banking systems in order to be able to accommodate as many as you can, as early as you can, as young as you can, right? My daughter's 23 years old. She just graduated. She started her brand new job. She bought her I have a policy on her when she was small, but she just bought her first policy that she's actually funding. And by the way, that's policy number 2, because she started one when she was 19, when COVID hit and we all got that stimulus money. She chose to start a banking system, $100 a month with $1,500 PUA. Now that she's working full time, she's an accountant, and she started, she came home to live with me to save some money. Now she's putting $1,000 a month and continues to put in, and she's 23 years old. And we have a 5-year plan. Every 5 years, she's going to increase that by 1,000. By the time she gets to be 40, how many policies can we get between 23 and 40, right? So this is a discussion that there's not financial education for us. It's financial education for our children. It's financial education for changing our kids' lives. My daughter will never be dependent on a banking system. As a matter of fact, her goal is the car that she has, I gave her. My son's turning 16, so guess what? Now her car's got to go to my son, so you got to go buy a car, girl, right? So therefore, you need to save up the money to buy yourself a car. Well, right now, as we stand today, she has $19,000 in cash value from her prior policies plus the one she started. By putting $1,000 a month, she will have $47,000 by December 31st. And she will go and buy her vehicle. And the greatest thing that has happened is that she says to me, oh, do I have to buy one for 40 or can I just buy a car for 25? And then I can just still have 15 saving. That's when you know that they're now, right, understanding not just the value of the dollar, but how to really, because now she says, well, if I buy a used car at 25 now, I can repay that back. I continue to build this. Maybe I can have the car and then maybe a down payment for a condo, right? So it's really teaching generational wealth as well. And I'm getting way off track here. I'm sorry, but so this is how a policy would kind of be funded, how it would be done. And I want to now take an example, and this is, by the way, on a whole life contract. I want to share with you a difference between a whole life and an index universal life. More and more, when Joe and I joined Joe back in 2000, when Alpha Omega 2001 was brand new. Really, the IBC concept was not very well known. It was, I like to call it purist, right? We all both learned under Nelson. We were blessed to have met him personally. I know Mike Stevens, who's going to talk later, also met him personally. He was a wonderful man. And really, he changed Joe's life, and then Joe changed my life. But now, 20 some years later, as it always happens, people take something pure and start turning it into what it should not be. And it should not be a system that incurs any kind of loss or any kind of market correlated situation. And IULs, indexed universal lives, are the kind of product where you can make and you can build and make it look like a superstar at the beginning. But There's so many internal costs and so many things that have to happen that they never sustain themselves. And I'm going to show you a sample of a client that came in. He had purchased a Index Universal Life with the IBC concept, thinking that he was going to accumulate cash and everything that we're teaching. And when we went through the illustration and we compared that to a whole life contract, it was staggering. So I'm going to share with you. He allowed me to share the illustration. So first, I'm going to show you the illustration that he purchased 2 months prior, and his commitment was to put in $9,530 a year, and you can kind of see, right? He puts in 9,530, accumulated 5,167. The next time 9,530 goes up to 10,000. You can see the accumulated value kind of going in. The difference between the 10 and the 5 would be the cash value growth in this example. At the end of 10 years, he had put in $95,300, and his accumulated value based on the guaranteed. Now, and here's the thing. I don't care what the index size says. If you're looking at an Index Universal Life contract, whether you have one or you're even being presented one, I don't care about the non-guaranteed side. You must always look at what is the guarantee, because if everything fails, how's the money going to grow in here? And here's the answer. For this particular client, he put in $95,300, and his accumulated value was $48,943. We keep going the next year, 10 more years. He continues to put that 9530. And by the way, in this scenario, the agent had him putting that amount for all the way to age 76, right? Which, again, it's not the way we build them, but this is just as an example. He would have put in $190,000, and his cash accumulated value was $79,738. The next 10 years, the total amount by the time he's 76, he started at 47 years old. Now he had invested or deposited $285,901, and his cash accumulated value was $51,000. And the sad part about it all this is, if he just has to continue to pay, by age 80, $9,530 was not enough to support the contract through the years, and the contract would have lapsed. Lapse meaning is if he did not put any more money in, the policy will terminate itself. Who in their right mind would think that this is a vehicle to do an IBC policy, right? And that's the problem. If you see out there all those advertising saying IBC Index Universal, run, because I can guarantee you that on a guaranteed basis, unless you overfund an IUL, and what I mean by overfunding mean paying a much larger premium. At age 76, this client would have received a notice from the home office, right, saying, hey, if you don't add another $30,000 to this contract, it's going to lapse. And here you are now, 76 years old, probably non-insurable, saying, what's going on here, right? Now let's compare this to a whole life contract, right? Same exact scenario, 47 years old, 9,530. I did it all years, just the way that they showed it. I wanted to make it an apples to apples comparison. And you can see here, at the end of the 10th year, both places you put in 95,300. And in our scenario, he has 93,473. It was not a well-designed policy because I'm trying to mirror the other one, but at least you have even numbers like Joe was talking about, right? In the next 10 years, you continue to put in the amount 190,600. The guaranteed cash value in the whole life contract is 214,683 versus 79,738, right? Which scenario makes more sense? Which contract, which vehicle is more efficient, more effective? Let's look at the next scenario. 276,000 deposits over a 30-year period, cash value accumulation guaranteed of 351,884 based on this contract, right? Look at the Index Universal Life, 51,000. And by the way, I don't have it going, but our policies get paid up meaning premiums are no longer due, more than likely between ages 76 and 78. In this scenario, at this age, there will be no more premiums due, even though there's more on the other side. And even though there's no deposits, the policy will continue to grow until you graduate, right? You put $0 and look at the difference between 365 and 358, that's your cash value growth. So, think about the vehicle, understand the vehicle, make sure that you look at numbers that apply to you. But also remember one thing, right? This is, and I said earlier, it's like a jukebox. It takes money to play. And people are like, well, I don't know where I could come. I don't know if I have enough cash, or I'm too young, or I'm too old. And this is what Curtis May from Practical Wealth is going to talk about next. Is this is all great and dandy, but it's a jukebox. It needs money to play. And how do you restructure your cash flow? How do you restructure your budget? What things are you spending money on? And how do you reorganize that expense in order to be able to find dollars that can be used to and rerouted to a properly structured life insurance contract? And I'll tell you, the exercise of going through a cash flow analysis and the exercise of looking at where is, for most clients, the biggest hurdle. It's excruciating to be true to yourself, to say, gosh, I make all this money, I've wasted all this money, to put the time to really look at your financial as a banker, not as a consumer, right? But as an actual banker, and to be able to implement those systems. That's also something that we're going to help you with. So before I turn into Curtis, I want to know if there are any questions about, and this was a very technical, very quick class on whole life. When we meet one-on-one, we'll dive a little bit deeper and we can look at actual numbers and how we can move that MEC line, that corridor. But if there's any questions at all on anything that I've talked about, let me know.
Yep. Yeah, we do. We have quite a few questions inside the chat. I think you might have answered some of them already, but this first one actually comes from Mercury. He says, supposedly my Northwestern mutual policy was whole life, paid up at 65, $1 million death benefit with dividends to buy up paid additions up to the MEC limit. Premiums, my healthy age, 31, was $14,000 a year. What was wrong with this policy where infinite banking failed?
You purchased $1 million of death benefit. Your dollars was buying death benefit. Mm-hmm. If I would have ran that 14,000 in a blended way, Ricky, probably I would tell you that the death benefit would have been 300,000, right? 400,000, instead of, because the cost of the insurance was greater than the amount of dollars. So I said this earlier, I think when I began, right? These banking systems contribute to your overall death benefit, but are not a death benefit driven policies, right? These are used to create cash. So death benefits will be, no, I will say this, be careful not to have enough death benefit, because dividends are paid on the death benefit component, right? On the base of the policy, not on the PUA. So if you don't have enough death benefit, if you don't have enough base premiums going in there, you hurt yourself in the long run, because then dividends won't be as high, which are a huge component of that policy growing through the years. So in your specific scenario from this question, and Joe stepped in if you want to, is that was not a IBC modeled policy. It was a death benefit policy.
I was about to type in a brief answer in the chat, but I think you just hit it exactly right, Yvonne. I was going to say there was nothing wrong with the Northwestern Mutual policy. It just was designed to do something different. Right. Two comments, and we do study what the other companies do, and we're not a captive company. There's just a handful of companies that we like, and there's one or two companies that really, really accommodate the banking scenario. Some companies don't like infinite banking. Why? Because it encourages clients to take control of their own cash, and insurance companies are banks, right? They want to control the money. If they're only lending money to us at 5%, but they could invest that money and get 9%. They're lending money to us because they have to, because the contract says they have to, but they don't necessarily like it. So there are companies out there, and Northwestern is one of them, that discourages loans. How do they do that? Well, they're charging 7% for loans, somewhere in there, 7% or so for loans. Number one. Number two, and I read the agent's contract. Northwestern discourages loans by penalizing the agent when when their clients, when their book of business has too much loan activity. So the agents are getting penalized because their clients are taking control of their money. It makes no sense, but that's what happens. Again, they're still a good company. Um, they just you know, they don't they do things a little bit differently than we do.
Yeah.
Can
Alright.
Any
can I share for a second? Um, I wanted to share because I've seen Ricky and I've heard him speak, and I've I can resonate with the rage because I felt the same way. And I shared in the chat that when I was younger, my background was a professional athlete, so I was able to bring in some good cash at the time. And I heard about having your life insurance and tax free, and I was paying $1,800 a month in premium for $1 million policy, which comes out to a little over $21,000 a year. And it was structured for, like you said, the death benefit. And you're looking at you're putting in $21,000 a year, and 2 years, 3 years go by, and you see zero in your cash value. You get upset. Now, unfortunately, later on, the person who approached me was not a Joe Pantozzi or Yvonne Burke or Curtis May. It was, a Primerica rep, and I got rid of it, which
Ouch.
was a mistake. Like Joe just mentioned, if you hold on to that, it would have caught up and all of that. It would be a huge asset for me because I got it in my 20s. But I try not to hold animosity to it because I figure they're doing what they were taught. They don't all these agents that you're dealing with, they don't know what you're being taught right now. So I'm going to chalk it to the fact that he's doing what he didn't know. He thought he was doing what was best for me, and this is what I wanted. He didn't know about the infinite banking concept to help give me more cash value. And then also some people do know, and like Yvonne and Joe mentioned, agents are paid on the premium aspect. So when we're helping people build more cash, the commission is less. So
Well, that's a great point, right? We take pay cuts to do the right thing because we're going to minimize the cost of that insurance, which is really where the insurance company pays us. So thank you, Robert. That's amazing. There's one question here says, is there a way to know what the maximum level is for a policy? Absolutely, there is. We have software that we use that we can look at that corridor. We can look at maximum, non-max, minimum, in between, and that would be in your individual one-on-one with the advisor that invited you here. We will have on the screen the calculators, and we would just build it from scratch. Each and every one of these policies are built and tailored to each individual person. No two policies are the same. No two situations are the same. We want to make sure not everyone has the same goals, right? So it's important for us to understand how we're going to build this, what is the purpose, how quickly do we need to start the banking function, how long are we going to accumulate, what kind of loans are we going to look, what kind of debt are we going to, whatever it is that your plan is, we will build and we will help you kind of find within that corridor where you're, which way we're going to go, maximum, middle, whatever it is.
And one last question too in the chat. It's if you insure yourself or an employee through the company, is the cost a tax write-off?
No.
The premiums, you mean?
Yeah. No. There's no such thing as a free lunch, right? So take a 401k. You can deduct the premium. You can deduct your contribution today. And of course, everybody tells you you're going to get a tax deduction, and everybody says, "Oh, that's great! I get a tax deduction." What tax bracket are you in? Real quick, 9 out of 10 people have no clue, so they have no clue what the tax deduction is worth. Right? Well, okay, it's nice to have a tax deduction, but if you don't know what it's worth, maybe you should pause for a second to find out what the deduction's worth, right? But 401k, deduct now, pay tax later. When I buy a key person policy, technically those premiums are not deductible, period. It's a non-deductible business expense, but it's non-deductible. But when my employee dies, I'm going to collect that life insurance benefit on a tax-free basis, right? So do you want, even if you were to make a mistake or try to get away with something and deduct that premium now, a couple $1,000s a year, whatever, you shouldn't do it, but many try, and you collect the death benefit at the other end, they're going to make that $500,000, that $1 million taxable, which was probably a bad idea. First of all, you violated the rules of the IRS, which you don't want to do. You don't want them, you know, taking up residence at your house, right? Um, and 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 secondly, look at the math. I'd rather not deduct the premium and get the ultimate benefit down the road tax free. And if I say anything that's untruthful, my CPA just logged in, so he's here, and he was a former IRS auditor of Fortune 500 company. So if I'm lying, he'll probably fire me, and you could ask him questions directly.
Any thoughts, Jack, on that?
You got 30 seconds, Jack.
Yeah, you're right about the premiums. One of the tax benefits could possibly be, though, if you did borrow money from against the cash value of the plan and you use the money for business purposes, you could get a deduction for the interest part of the payments. The premiums, Joe, is 1,000% right. You don't get to deduct the premiums, but say you wanted to borrow money from the policy to go buy something for your business, well, the interest on that policy loan would be deductible.
Man, you just checked in at the right time, Jack. Thank you.
Awesome.
Perfect timing, right?
Perfect
And
time.
he happens to be an Eagles fan. I don't know. Don't understand that, but
Let's go Birds.
We have a
Yeah.
hand raised. Hold on.
Ashley couldn't hear you.
Sorry, we have a hand raised. Leslie, we have a hand raised. Do you have a question?
Yes, I do. The question that I have relates back to the business question. I know you said about the key person can get an insurance policy on themselves, and also as it relates to them getting insurance policy on the employer. If the employee leaves the company, what then happens to the insurance policy?
Well, for those of us who are business owners, this is where it really gets good. Um, without mentioning any names, because some of you on the call know who I'm talking to, but we're not going to talk about the name here. When that policy is put into effect, the insurable interest must be in effect on day one. So I have to have an insurable interest in the person's life on day one in order for me to get a policy. If that person leaves my company next year, I get to keep the policy. It's my asset. It's not going anywhere. Nobody can take it away from me. That's the way life insurance policies are designed and contractually built. It's an asset of mine. It would probably be to my best interest to track and see if that person is still alive 10 years from now. But if they die 20 years from now, I'm collecting the benefit. It's tax free. I built up all the cash. I had access to it. I could access loans. I have all the rights of ownership. And the employee has no rights of ownership if that's the way we set up in the first place, which was our scenario. So I get the best of both worlds. I get to continue to maintain that policy as an asset, and I get all the benefits.
Cool, perfect. Thank you, Joe. Leslie, does that answer your question?
Yes, it does. Thank
Yeah.
you.
We'll answer one more and then we'll let Curtis. We're running just a little bit behind. And they continue. And we're going to leave some room in the very end. But I do want, Joe, if you can answer the one that says life insurance companies must put premiums to work. What type of investments are made exactly? Which is an excellent question. What do insurance companies invest in?
Sure. Well, first of all, they don't take risks. So the insurance companies that want to remain solvent, right? The insurance companies that need to have assets to fulfill promises 100 years from now, 120 years from now, they're only putting money into guaranteed or virtually guaranteed investments. So they're buying into four things. They're buying into government bonds, corporate bonds, mortgages on typically on commercial real estate. So a life insurance company lent, let's say, $10 million to my client who's a contractor. He built a medical office in Pahrump, Nevada. And so They know that a medical office is a very high probability of success. They know the track record of the borrower, the contractor. They know that the industry is safe. They invest in nursing homes, senior homes, assisted living facilities, industries that support elder care. They invest in those industries in terms of the real estate. They lend money on them. They may buy buildings outright. So it's bonds, corporate bonds, government bonds, corporate and government bonds, real estate, mortgages, and real estate itself. When they lend on the real estate, it's lower loan to value. They're not giving out 80% loan to value. Might be 60%, might be 70%. But my contractor client told me when Emeritus loan lends me money, they put me through the ringer. Man, I can't be 5 days late because I pay a penalty. He says, but I know they're good because the money is there, they honor their contract, and they hold me to my contract because I know I can deliver a building on time. So I know I have no problem borrowing from them because I won't be paying penalties. So they're again, they're creating assets enough to back up their liabilities, a dollar for a dollar, as opposed to, FDIC, $1 to 100, right? As opposed to the stock market, which is basically a risk investment, which fewer people understand that than understand a savings account. So hope that answers your question. 4 places, guaranteed, wallpaper the place with guarantees.
Awesome. So we're going to hold off in a couple questions until the end. Let's get through so we can finish. I know we're a little bit behind, Curtis. I apologize, but we're okay.
Hi there.
So if you want to share your screen, Curtis is going to talk about finding the money, right? Budget and how to look and see how we fund these policies. So take it away, my friend. By the way, Curtis is president and founder of Practical Wealth Advisors, Philadelphia. One of our trusted partners, and thank you for sharing with us.
Go Birds. Yes. So so what we're going to talk about today is this is one of actually my favorite topics because I think so now I think you know the flow. I want to answer one other question. So because a lot of people will come to me and they'll hear whole life and they buy a whole life policy and they think, well, I got a whole life, why don't I have all this money? But one of the things I always tell people that if you hear the whole term, it's we help people buy properly structured dividend paying whole life with a mutual company. Okay. So that statement right there narrows the field from 1,500 companies to about 12. Okay. And then we're all going to the Infinite Banking Think Tank next week in Florida. So that narrows the field of people that know how to do what Yvonne and Joe were talking about to, I don't even know if it's 2,000 good ones, people that actually know what you're talking about. So that it's a specialty, just so you know that. So don't be mad. Just, we got it. That's why and if they don't literally beat you over the head with the book, they don't do it. Okay. So, because the book is coming out in within 10 seconds of me meeting you, if we're talking about this, and I don't literally hit you over the head with the book, but I might if I told you to get it and you haven't gotten it within 48 hours, then I might beat you over the head with the book if it's not a Zoom call, just so you know. Then you meet Coach Curtis. And Coach Curtis is not a nice man all the time. I'm going to tell you what to do. So anyway, but here's the fun part. So I'm going to show it a little bit differently. So one of the things that I talk about is it's not about the policy, right? It's a banking's a process. It's a system of money management. Okay. And so I call this our personal economic model, and then I'm gonna get into some specifics, but I want to start what most wealth is lost by how people manage cash flow. So we call it the lifestyle regulator. You would call it a budget, or in your business a P&L. But what you have to do, money comes into your world 3 ways. Through income, W-2, it comes through your business or your investments, that cash flow, and then it comes in your world through what I call inflows, then it's outflows, and then there's pushing money, what I call up the green tank, which is the policy, is a capital flow. Okay. It's saving. See, what most people do is they save and they take it back out. They save it up and they take it back out. What we've been sharing with you is that, hey, how about we position your money so you can collateralize it, borrow against it, be able to use it for expenses, for opportunities, and have your money continue to grow, compound uninterrupted. See, compound interest works best over time, uninterrupted. Okay. So you got to put it in a proper position. But now we're talking about, well, how do you get money into that? So a lot of times I see, so when I work with people, I look at this. So I start people with cash flow control. Most wealth is lost here. And so if your outflow is greater than your inflows, then your upkeep becomes your downfall, right? So if you can't save, if you're not spending more than you make, no, what did I say? Hold it, let's back up. If you are spending more than you make, and people say, I'll say, well, look, people call me, oh, you know what? I heard about this bank thing. I want to be a bank. How much are you saving? Oh, I don't save. Well, you can't be the bank then because it's a saving strategy. Okay. Right. So, it's not a magic money box. All right. So I'm like, you come to the emergency room. I have to throw you down on the table and plug the holes. Okay. That's where we start. Okay. I got to make sure. And so we got to find the money. So I'm going to show you big areas, but it starts here. And so most people, the problem with the way people do cash flow, most budgets are tracking tools, right? So focusing on budget, even your P&L is like driving a car forward, but you're looking through the rear view mirror. So all they do is look at history, okay? What I teach you to do is look through the windshield and sort your money out and map your cash flow. So that's critical. And so now, because what I want people to do to save a minimum of 15, 20% or more, right? So I teach people in order. You got to manage your cash flow so that you have capital so you can capitalize your banking system. All right. So it's like 1, 2. I'll just show you the whole thing. The whole thing I teach is you got to do that. You got to protect, and then you got to invest. Investing's last. So it's 1, 2, 3, 4. They're concurrent, but there's an order. Most people think you're supposed to invest. And the problem is why people don't feel they can do it, because we've been trained to put our money in little, what I call silos, qualified plans. So you basically put your money on lockdown for 25 years, 30 years. You put 20,000 in a SEP to keep, you put a $20,000 away that you can't touch to keep from writing a $5,000 or $7,000 check to the IRS, and you put a lot of money out of your control. So it's just, there's a lot of stuff that we've been taught. See, when you get a financial advice, all financial advice taught of what I call the accumulation theory is built on 4 premises of all financial institutions. Here's what they want. They want your money. They want it on a regular basis. They want to keep it as long as possible, and they want to give it back as slow as possible. Okay. So there's nothing wrong with that, but you've got to know, because they're in business, but you've got to make the products do what you want them to do. So what you've got to do is you've got to take apart the system and make sure what you're doing serves you. Because here's the thing. Because a lot of people don't realize that you're gonna make a lot of money. So one time I won't do this exercise, but I did exercise with these college students, and I said they were 18. I said, "What do you think you're gonna make a year?" In fact, let's do that one. And they were 18. I said, "Well, if we were having this conversation when you were 28, and they were Penn students, I was doing this talk for these college students, and I said, what do you think you're gonna make coming out of school? 50,000? This is Penn. We're gonna make 80. Okay." This is about like 5, 6 years ago, right? Let's say they start out with no money in savings. I'm going to not show a little bit of income growth, and let's just say they're getting 4%.
Only $80, Curtis?
It's better than that. Depending on the degree. No, I was kidding. All right, so the and then let's say you can get I'm just going to have it go into savings because I want to calculate something. So what happens is by the time they're 28, they will have earned that will flow through their life $836,000. Okay. So if I could write you a check for 800 grand, would that be significant amount of money? Would that change your life? Right. But here's the thing. It's the same money. You're just getting it bi-weekly. Okay. So we don't pay it because I say, oh, look, if I gave you this money and this is all the money I'm going to advance you is $800,000, but you're not going to get a paycheck. You still got to go to work, but we're not going to give a paycheck. Would you treat this money differently? Yes. What would you do? I would watch it. I would invest it. Okay, well, it's the same money. You're just getting it bi-weekly. All right. So it's all in how you think about it. But so what most people do, and that's because you got to understand there's a reason why you need to take control of this money. So this is what you're going to earn, but that's not what you keep. Now, what happens is, let's say it goes all to lifestyle. And so what most typical financial advice, they have you chasing rates of return. We don't take that approach. So most people money's lost by how people manage cash flow and through what I call wealth transfer. Transfer is money leaving your asset column going to somebody else's. So number one is taxes. I'm going to lowball and say, let's say 30% of your income is going to taxes. All of them, not just federal. So all of a sudden, uh that's money gone. Okay. So now let's say, what does Nelson say in the book? 34.5. Let's just say 35% is going to debt service. And let's say you're saving that right now, according to the Federal Reserve, most people are saving 5%, less than 5%. So out of that 88,000, the only thing you have to show for is $44,000. Okay, so you can go to Uncle Dave and say, well, he tells you, well, you can get these 12% mutual funds and chase returns. That ain't going to get it done. Okay, so you see what I mean? So you have to control the cash flow. And so let's say you could get in a good policy 3-4%. Okay, but here's the thing. So is it possible that you could lower your taxation to 20 or 25%? Yes, if you change the nature of your income. Out my lane. Okay. What if we could eliminate the majority of your what I call non-preferred debt? Now, and because what I ask people is, if I find it, I'm going to show you some areas. If I find it, will you save it? So all of a sudden, now out of that 800,000, you've got almost $400,000. Now, what if this was in your policy? That's where the money comes from. Hope that makes sense. All right. So now let's look at this. And then I got like 10 things you can do. I'm going to go kind of granular, but I want to give you a big picture first. So there's really 3 types of money, guys. There's accumulated money, there's lifestyle money, and there's transfers. So most typical advice is built around, like if I was with Merle or Edward Jones, my conversation, if I met you guys, is how much you got? We can do better. Why don't you move that money over to us? Right? But when you're getting that type of advice, who's the only person whose money's at risk? See, yours. Everybody's guaranteed to make money but you. Okay. So you put up, matter of fact, according to Jack Bogle, you put up 100% of the money. You take 100% of the risk to maybe make 20 to 30% of the profits, if there's any profits at all. Okay. And you think you're investing. I don't actually call that investing. I call it speculating, but that's just me. All right. That's another seminar. So now there's lifestyle money. So you got to stop going to Starbucks. You got to, so when we say, look, people think budget, they think I got to put myself on an austerity program, and nobody's really trying to do that, right? That's a scarcity focused thought process. And so you want to cut back on lifestyle. So I tell people, look, I am not the party pooper. Okay. And I'm not, I'm not, I'm not in the lifestyle reduction business. I tell, Dan Sullivan says, if you want to double your income, you have to double your time off. So I'm all for that program. All right. and I think we went on 4 trips last year and still made okay money. So, because if I'm the run the company, I've got to recharge and have something to work for. So, but so most people think, I'm going to lower my lifestyle so I can put money here somewhere where I can't touch it. So, what I'm going to do is I want you to take, see, if you want to create maximum wealth, you have to create maximum efficiency. And this is how you find the money, which is what I specialize in, helping people find money that they are losing unknowingly and unnecessarily. And what we look at is transfers, right? So if we look at the transfers, we can lower money that you're giving away, create more accumulated money. And at the same time, I want you to live the best life you can. And I ask our clients, where would you like to start? You want me to help you take more risk? You want me to tell you can't go to Starbucks or can't go on vacation, or do you want to find money you're losing unknowingly and unnecessarily? That choice is up to you. Now, let's break it down. So I'm not going to talk about opportunity costs. Let's just go here. So, and I'll go more into details with this. So once you get past managing cash flow, now we're going to look at some of your big rocks. And so when I sit down with people, there's certain things I see depending on their income bracket where I see the same 3 or 4 things over and over again. And a lot of times we can help people reposition money they're already spending without taking more risks, without costing them any more money. You just have to look at money differently. So there's 6 here, right? So how you pay your mortgages uh is a big one because that's what one of your biggest purchases. So uh I might step on some toes. 15-year mortgages, sending extra to your mortgage payment to pay it off early. That's a complete waste of money. Okay. So if you're doing that, that money could be redirected to create a pool of capital that you own and control. Okay. So now I just threw that out there. So I guess I should, I should explain it a little bit. But so what happens is, think about this. So I love this because I can have every conversation about money. So first of all, see, I want to get out of debt. If you have a mortgage, you're not in debt. You have a liability. Debt is when you have an obligation where the only way you have to pay for it is with money you have not yet earned. So you're using future earnings as collateral. So it's important to classify that, right? So now if I'm looking at my house, so my house is worth 400,000 and I have a mortgage balance of 200,000 and I've got money in savings, I've got a business, I've got investments. Are you in debt? You're not. You have a liability, right? So now when you're paying, and so the first rule of wealth, right, out of the richest man in Babylon, part of all you earn is yours to keep. And the third rule in the Rich Dad Poor Dad is mind your own business, which is your asset column. So what people do is they want to mind the bank's business, the credit card company's business, and you're saying, all right, I'm going to bypass what makes me wealthy, and I'm going to focus on, because your liability is the bank's asset. So I think it's important to me to pay this off and give my money away, because once it's going down the drain, you never see it again. So that goes to opportunity cost, which we have time. I'll come back to that. So here's the thing. So if you pay extra on your mortgage, ask yourself these questions. I'm gonna throw them out real fast. We don't have time to go into them. Does paying extra on the mortgage make the value of the house go up? No. Right? Does it make the payment go down? No. Right? Because it's a term loan. What's the rate of return on equity? 0. The house appreciates regardless of whether you finance at 100% or you paid cash. So the rate of return is equity. And then if you're not careful by paying also on the mortgage, because you see the house as the asset, the bank sees the house as collateral. Their asset is the note. So when you're paying extra on the mortgage, you're strengthening their position, right? So if you you're turning your house into a qualified, another version of we call a qualified plan, because if you got sick, you got disabled, I'm from South Jersey near us. You have a Sandy and your house is down the block because of the hurricane, that equity is gone. Okay, because the house is gone. And while, so now if I've got my more money mortgage to the hilt while you're worrying, fighting with the insurance company, my money's over here in my side fund, over here in my policies. I'm mailing back the keys and getting on with my life because I have access to my capital. Right. And so that's when, and the key is control. All right. So that's one. All right. Mortgages, taxes. Your number one wealth transfer is taxes. I'm not going to give got Jack on here, but here are a couple of easy ones I see with people that are W-2. They're over withholding. Okay. So if you get a big tax refund, your W-4 is filled out incorrectly. Okay. And you need to go to irs.gov they made it more complicated, but you got to do a little bit of research on it and you want to adjust your withholding. So many people think, well, I've got one child and so I claim what they'll do, Yvonne, they'll go, I just claim one on my W-4, right? And so they're thinking uh, what are they called on the tax return?
Like overpaying, paying more than the
Yeah, but on the tax return, when you have a child, dependents, they think dependents and allowances are the same thing. So most people have, according to IRS, 80% of people have their W-4 filled out wrong. They're not, you could do income shifting if you have a side hustle, okay, and begin to stuff that you already, because our tax code, guys, is designed for landowners and business owners, okay? So I always tell people don't hate the player, hate the game. You got to know how the game is working so that you can keep more of your money because tax is your number one expense. How we fund qualified plans. Um, I'm gonna come back to that and I'll show you what two things they do. And if you look at the tax history, what we've been taught, again, remember the four rules of the financial institutions, don't they play right into what the financial institutions want? They want your money, they want it on a regular basis, they want to keep it as long as possible, and they want to give it back. Never. Okay. So if I was a assets under management guy completely, and you came to me and said, Curtis, I just found this multifamily and I need to pull 200,000 out of my account so I can go buy this real estate. Are they going to be happy about you doing that? No, because what's going to happen to their income? Because their income is based on fees. Now that still might be a best thing for you, but they can't get paid off of that. So there's nothing wrong with that. You have to control your life, but you have to manage your cash flow. Like you're the CEO of your life, so you've got to control your money. And so you want to analyze your coverages. Some people are spending too much. Some people, because this is a protective expense, so you're not necessarily trying to cut this down. You may have to put some money here because you're playing defense. Like I always tell people in your financial world, Curtis is the defensive coordinator. So do you have a will? Do you have a trust? Do you have maximum protection? We don't think you can meet your maximum wealth potential without permanent life insurance as the foundation of your house, money where you have liquidity, use control of your capital. How you fund educational expenses, 529 plans and things like that. Well, that money, when you get ready for school, you say, oh, I got 50,000 in my 529 plan. College is going to go, hey, great. That's 50 grand you don't need from us, right? Where if I have it in a permanent policy, that money's invisible to FAFSA. I've used mine for my expected parent contribution. I've taken policy loans to do that. Even though we make, pretty good income that we maxed out on their ability to get, funds and what have you, but I still had money I could use for them. So it's where you store it. Okay. Major purchases is huge. So, Joe and Yvonne talked about buying cars. So it goes back to the 35% that you're giving away. Major capital purchases, anything you can't pay for in full within monthly cash flow. So there's another five, there's fees, but those are the big rocks. And now I'll take a breath, but I'm going to switch to a PowerPoint and I'll show you a few more about eight or seven or eight or so little things that I think you should look at. But up to that point, Yvonne, while I switch, are there any questions?
Yeah. Any questions for Curtis while and obviously this is a component that is individual to all, and this is part of the process that we put you through while we are learning more about how the policy, while we're looking at finances. This is right, the discussions that we will have on our one-on-ones individually, um, in order to be able to maximize funding. So any questions
Once
up
you
until
get the concept, you now it's where's your money going, and you have to capitalize your banking system. Adam Smith says a bank can't make a loan until it has a deposit. So you've got to redirect monies here, but we try to help people do it so you don't really have to change your lifestyle. You don't, the money's most for people, the money's there. You just are not paying attention to it. Otherwise, I'll keep going. Any questions?
No, go ahead.
All right. So here's the thing. My favorite book, Richest Man in Babylon. If you have not acquired more than a bare existence in the years since we were youth, this is ARCAD. It is because you have either failed to learn the laws that govern the building of wealth, or yet, or else you do not observe them. Okay. So the first one being start thy purse to fattening, which means pay yourself first. All right. Pay yourself first. Here are seven. All I teach is chapter 2 of The Richest Man in Babylon. The 7 cures for a lean purse, or in today's terminology, the 7 cures for an empty bank account. I should have put this slide in here. And start that purse to fattening. Pay yourself first. Budget thy expenses. Manage cash flow. I'm about to show you that. Make your goal multiply. So when you manage cash flow and you put money in the policy, if all you do is let it sit there, accumulation doesn't work. You have to create velocity. So that means you have money working in more than one place, right? And so what can you do with it? You can you can recapture big ticket items, or you should be buying or building assets. Income follows assets. What's an asset? Something that puts money in your pocket. So and investing is really more about becoming something than about buying something. So do you want to become a good business owner? You want to become a good real estate investor? And assets, cash flow. All right. So now here's the current problem with managing cash flow. So, and I was kind of hinted at this. Most budgeting tools are expensive tracking tools, and it's like looking through the rearview mirror versus through the windshield, telling you where you've been. What you want to do is you want to look through the windshield to figure out where you're going. So that starts with cash flow. So I take people through a process called cash flow mapping. Most people are caught up in what I call the circle of confusion. Like they got, because it's easy to spend money. Spending money is easy and unconscious. Apple Pay, Venmo, what's that? Timo, Amazon. And so it's easy to spend money because that's the default position. One of the things that we do is we talk about creating a reservoir where your income goes in, and then you want to sort your money. All right, what are my fixed bills? Which static? What fluctuates? And what do I actually spend, and then what's left over? So when I take people through this exercise, I had somebody recently, we found about $1,600 a month. So, and because I'll ask people, say, listen, if I find it, will you save it? All right. And then, or we've got to look at this. So I'll show people, because most people are trying to pay their debt off incorrectly. Okay. And we'll talk about that. The same thing on the business side. Most businesses, if I can't tell me a business, they don't even look at their profit and loss, let alone know how to read it. This is kind of a variation um, of that I do and teach, called on profit first, right? Where money comes in. Like if you leave all your money in your operating account, the business will eat up all the money you give it. So you have to separate that out. Okay. And so to me, you got to get in control of that. And so like for us, what I'll do is I'll say 15% of our gross revenue. Well, this is one of the places where the capital comes from to fund our policies. I also pay myself 35% of revenue. And then when I save it, I put a percentage of that in our policies. We have six. So, but I'm really anal about cash flow management, as you might be able to attest to. So now, so there's three types of money, right? There's accumulated money, dollars you're currently saving, investing, lifestyle, and transfers. So I'm going to emphasize transfers because that's where the opportunity lies in stopping wealth transfers. So let's look at 10 ways you can free up cash flow to redirect inefficient money into your policy, right? So you can identify high interest rate debts. You could refinance, consolidate, or pay off strategically and redirect those savings into policies. So I had a person, we went through the cash flow map. So they had $4,000 a month allocated towards debt elimination. So when I isolate at $4,000 a month, they're paying on about, I don't know, $60,000 worth of debt. But when I separated them out, the minimum payment was about three, and then I add up all the overpayments, it was about four. So I'm like, and so what happens is they're so spread out as to be, it's like spitting in the ocean, you know. So I said, look, what if you need to pick one and then deploy. It's like the snowball, right? Deploy all of that on one and then pay it off. What I actually told her to do, I said, listen, let's save $500 of this because if what's the point of paying off all the debt? You're broke. All you did was transfer your wealth to Visa. Okay, so we're looking at with and that was just one area. I just found money just looking at the debt. She's getting a $4,000 or $5,000 tax refund, right? So we're looking at that. So all of a sudden, this stacked up. Usually we'll find $500 a month. My personal record is about 4,200 a month of just restructuring what they had going on, and then we're able to redirect that back into the policies. So that's one way. I'm not going to go into great detail, but just analyzing, getting people to analyze the numbers and say, okay, look, I'm inefficient here. Let's redirect this into a pool of capital that I own and control. And you can even use some of that money to your bank buys the debt back from Visa. That's a whole talk in of itself. You want to look at, so now we'll go to lifestyle. That's not where I start, but I had a couple with money was tight and they got like four different subscriptions. You know, I had a mentor say, listen, if you're not making 100 grand a year, you should have no damn cable, right? You need to be, read a book on how to make some money. But the thing is like, are you efficient? Do you need every cable channel known to mankind? You don't need to watch that much TV. Though I'm not here to tell people what to do, but I will make strong suggestions. Are there unused expenses? Or you have double payments? Are you uh, you know, a lot of times people will have, let's say on your payroll, your voluntary benefits, you'll have double coverages, you'll have so much Aflac stuff. And I love insurance, but you have to ask yourself, what am I at risk for? And if you have all this money, you have they put in an easy one is, you're putting in $15,000 a year. And I say, well, do you have a 401k? Yes. How much are you putting in? 15,000. Do they match you? Yes. How much? 5%. Hmm. Maybe. And you don't have $3,000 in cash. Maybe you can either lower it. I don't have a problem with you suspending it for a year because you're out of balance, right? You need access to capital because if you don't have access to capital and the first time you have an emergency where you need some money, what's the first thing you got to do?
Liquidate the 401k.
Well, that's the second. What's the first thing? If you have credit cards,
Charge them up.
charge up the credit card. So now you're right back where you started from because if you have when people I talk to people and they have less than ideal credit, they've got FICO score, they've got debt, and they have low savings. Those are symptoms of poor cash flow control or bad decision making. Or maybe they're out of work, but most time that's a symptom of that. So you have to get really in touch with your money. we talked about this, reallocating retirement plan contributions. Liquidity that's an easy one. That's one of the easiest ways where I don't tell you to stop it, but if you look at your personal economy and you're saying, I'll show that little yellow tank, green tank, and I'll show all this money here in the yellow tank, and I'll see very little in the green tank, and I'll just have them look at it. I say, look, what seems out of balance to you? And it jumps out at you. It's like, yeah, or something were to happen, you don't have any access to money. Access to capital allows you to sleep at night. It gives you peace of mind. I don't care that if it's not making money. That doesn't matter. Look how much cash Buffett has. You need dry powder to take advantage of opportunity. Nelson Nash calls it the golden rule. He who has the gold make the rule. So we just don't have enough capital. Most of the best investments, you need capital. You need 50 grand. You need to be a credit investor. So you're not going to get anywhere doing $200 a month in Robinhood. Okay. You you need to invest in your own enterprises, invest in your knowledge. Okay. So optimize taxes, avoid overpaying. So you could use deductions, credits, entity structuring. I was talking to somebody, again, I try to stay in my lane, but if I know they're making like 75 grand a year and they're either a sole proprietorship or they're just I have an LLC. Well, LLC in of itself is not a tax savings tool. It's an asset protection tool. So there's a point there where I tell people you might want to go back to your tax professional in tell me you're reading something about, when is it time to convert to an S election, right? See, because you have to lead your wealth. You can't wait for people to tell you what to do. It's your money, okay? And you have to be in control of your money. You can adjust your withholdings. You can redirect that money into a policy. So all of a sudden, you see where it's $200 here, 150 there, 300 there. All of a sudden, we're finding five, six, $700 to redirect back under your control. All right. You can every dollar you spend on interest is a wealth transfer. If you pay a tax that you didn't have to pay, that's a wealth transfer. And then if you pay it, that money's gone, but it doesn't end there. If you paid $10,000 you didn't have to pay because you didn't get tax advice, well, now let's say if you could get 12% on investing in your business, well, if you use the rule of 72, money at 12% doubles every 6 years. So it's that 10,000 at interest you're losing every 6 years because it's still working. It's just not working for you. So this is part of what the bank does. It allows you to store capital where you can get opportunity costs working for you. So you got to find it, you got to start it. You need to review your insurance costs. If you've been in property casualty for 3 or 4 years, you think that, well, I've been there a long time, I've got the best rates. No, they give the best rates to the new people. So you need to refresh your homeowners rates. Most people are still underinsured. So you need to have them reviewed anyway. Don't have umbrella policies. Their liability coverages are too low. You got to check if you have replacement costs, but I would shop that. Okay. And that those savings, if you have enough savings, you can raise your deductibles. If you have enough cash value, you could pay annually, which is a little bit cheaper, right? And then you're recapturing all that money. See, so this all stacks on you having access to capital. You could refinance and pay off high interest rate loans. I like to see the numbers. See, too many people, they want to do bankruptcy, they want to do these debt consolidation things because they're tired of people calling them, but you really need to sit back and you have to think. That's why the book Think and Grow Rich. Think and grow rich. For a reason, you have to slow down to speed up and get a pen and paper and do some calculating. You got to think about your money. It's your money. It's your job to make yourself rich. It's nobody else's job. Get a side hustle, right? What does Jim Rohn say? Wages make you a living, profits make you a fortune. So you need to earn your living by day. You need to work on your profits at night and on the weekend. The tax system is designed for you to, want you to have a side hustle, right? So now you keep more in your pocket and you need to really be trying to make money. And so that money can go towards saving, funding your policy, debt elimination, right? Down payments. You get a duplex. Now you got more assets helping you grow. And what if you could buy a house every year, every other year for the next 10 years? What would
I'm so
that
glad
look like?
I'm so glad you said that because that is the next presentation is purchasing real estate using right the banking system, a house every year for 4 years.
Yeah, and so we're you know, it's just basically you want to look for maximum efficiency across the board. So you really have to get your numbers out, look at it, and see, all right, because all banking is creating a pool of capital that you control that can move at cost to meet some needs you have. So again, a bank can't make a loan until it has a deposit. Okay, so you want to analyze your finances and let's find the money and let's get you, you know, you can be a customer of the bank. I always tell people, or you can be the bank, right? And so you're here because you want to be the bank, and that's my little part, and I hope
Yes.
that's helpful.
And I think, and again, right, it's a limited time, and this is a much greater discussion. We're happy to um, make future more directed. This conversation that Curtis just went through right now, he hasn't even begun to talk about the vehicle that he uses once you find the money through a account, a segregator account. We can certainly set up a class just to talk about money flow and how to put together a segregator account to fund policies. That's a whole other discussion. So I'm going to hold off the questions from Curtis until the end because the next presenter, Mike, is going to, now you found the money, now we funded the proper policy, we're ready to roll, and now we're going to talk about how to purchase real estate sample using your banking system. And Mike Stevens from MTEL, our partner, will go through putting that IBC policy into action. So take it away, Mike. And by the way, if we go, you have the full half hour. If we don't get to any questions, I'll make sure to get them all answered. But this is an important discussion because you can do all this, right? But the key is how does it work once it's all put together? So Mike, take it away.
Okay, so I got to
just play the PowerPoint, yeah.
There we go. Okay, I had to stop my video because I get lag here. I'm in the country, so I don't have great Wi-Fi.
What is that, the great state of Wisconsin?
But so, Yvonne, can you see my screen?
Yes.
Everything good to go? Okay.
Yes.
So I'm going to run through this fairly quickly, just for the sake of time. But this is putting IBC into action, creating the velocity that people have talked about today on the call already, and specifically with real estate. So I'm going to make an assumption here that let's just say you're going to start with a $100,000 policy. We're going to structure it like has been discussed, putting $40,000 into the base and $60,000 in paid up additions. And then we're going to use this policy to go out and purchase real estate. So year one, you're going to put $100,000 in. You're going to have cash available. Again, since it's designed properly, you're going to have about 60% of cash available in that first year for $60,000. So we're going to go out and buy real estate, income producing real estate. And we're going to do the conventional way, putting 20% down, and we're going to finance the other 80% using a commercial bank. Okay, so if I can put 20% down, 60 grand, I'm going to qualify for a $300,000 house. So get that 80% from the bank. I'm going to be able to go out and buy a $300,000 piece of real estate. So in doing that, one thing that I'm looking for is I want 5% return on that total cost or 25% cash on cash. So on a $300,000 piece of property, I want to net, this is after PITI, R&M, I want to net 5% or 15K. And 15K is going to be 25% cash on cash. That's my parameters. That's what I'm shooting for. And this isn't necessarily a concept. That's a pipe dream. I've had people tell me like, man, that's really difficult to do in today's environment. I'm doing this. Same thing. This is the minimum that I look for. If I can't get 25% cash on cash, I'm not doing the deal. I've done this in in rental property, residential rental property, single family residence. I've done it in commercial property. Commercial property is a little riskier. However, the return is higher. Riskier from the standpoint that, if you want to sell a home, it's pretty easy to sell a home. Selling a commercial building is not so easy. But these are numbers that you should be able to attain. And it may not necessarily be in your city. The residential rental property I have is not in my city because it doesn't work in my city. So you may have to look elsewhere to find that. But this is kind of the rule of thumb, 25% cash on cash. So year one, I buy a $300,000 piece of real estate and I'm netting $15,000 a year. That's going to come back into my banking system. Okay, so then in year two, in my banking system, we're talking about obviously an IBC policy. Year two, I put $100,000 in. Year two, I'm going to get pretty close to $100,000. If it's my wife, or certainly a lot younger than me and my wife, you're going to attain that $100,000. For me, because I'm male and they sexually discriminate because actuarially men die sooner, I'm not going to get 100,000, but let's just say on ballpark, depending on who you are, it's going to be dollar in, dollar out that second year. So again, I put 100,000 in, I have $100,000 available plus the 15. That's $115,000. So, but I'm not going to use the full 115,000. I'm just going to use the 100 to be conservative. So year two, I'm going to take $100,000 of that, 20% down payment. I'm going to qualify for a $500,000 property. Or if it's in the case of, rental property, you're probably not going to purchase a $500,000 home. Maybe you purchase two $250,000 homes, whatever, but $500,000 worth of rental property. Again, 5% total return or 25% cash on cash. You want to generate $25,000 from those properties. So again, year one, I purchased the $300,000 property, is generating $15,000 cash. This second year is $25,000. So a total of $40,000 cash flow coming back into my banking system a year. One thing that I want to point out is on this policy, since we designed it with a $40,000 base and a $60,000 PUA, the commitment on this policy just for the base is $40,000. So in 2 years, I have just generated a system that'll pay for my policy for the rest of my life, while still increasing my equity and the real estate that I'm purchasing on the right side of this. But anyway, $40,000 coming back in year two. So again, year three, put $100,000 in. Again, dollar for dollar, I got $100,000 plus the 40 I'm generating from the rental property I already have. That's $140,000 I have available to go out and buy real estate property in year three. $140,000 at 20% down. I finance 80% from the bank. I'm going to qualify for $700,000 worth of property. Again, that may be 2 or 3 or 4 or whatever rental properties. It may be a commercial building or whatever. Income producing real estate, $700,000. Again, 5%. I want 25% cash on cash. That's going to be $35,000 a year from those properties. You add that to the 40 from the previous 2 years. That's $75,000 per year coming back into my system, into my IBC policy. So then to take it one more year, year four, I put $100,000 in, again, using dollar for dollar plus the 75 from the previous 3 years. That's $175,000. Just to keep the numbers simple, let's say I'm going to go out and buy $900,000, and you're like, well, wait a minute, 20% of that is 180. Well, don't forget, back up in year two, I still had $15,000 that I really didn't use there. So again, just conceptually, and to make the numbers simple, we're going to go out and buy $900,000 worth of income property. Again, 5%, 25% cash on cash. That's another $45,000. So to recap here, In 4 years, we've put in $400,000 into our system. As far as the money put into real estate on the 20% down, that's really not our money. We're using the insurance company's money, taking a loan, borrowing against our equity or our cash value inside of our policy. So we really don't have any of our money in the real estate. We're using the insurance company's money and the commercial bank's money to purchase the real estate. But for $400,000 investment into our policy over 4 years, we've generated $120,000 of annual income. That's 30%. And again, Jack's going to hop on here and say, well, wait a minute, the taxes. Jack's my accountant as well. But $120,000 on a $400,000 investment, 30%, that's pretty good. Plus, don't forget, we've purchased $2.4 million worth of real estate that is basically cash flowing and paying for itself. And we also have the protection from the death benefit should something happen on the left side of this. So I'm jumping ahead of myself here. So, so real quickly, the benefits of this strategy. Again, $120,000 of passive income generated each year. You have a death benefit that's growing that's going to protect your family, protect your legacy. You have the tax-free dividends paid into your policy every year that's constantly growing. In year 5, after that's done, again, even if you just took 40,000 of that 120 and paid the base, there's another $80,000 of passive income coming in. You can go out, buy more properties, start another policy, increase your banking system. Flexibility of paying down loans, that unstructured. Curtis mentioned that when you pay on your house, it doesn't reduce your payment. But yet, when you're doing this inside of your own system, you have lots of flexibility there since it is unstructured. You have the creditor protection, living benefits years later, disability, et cetera, like Joe mentioned inside the policy. Lots of benefits by using this system. And so anyway, I know I flew through that, but that is a real quick scenario on how you can use your policy and start building income, start building passive income, increasing your real estate portfolio, all with using just one IBC policy. So
yeah, and again, this could be a whole class on itself, right? We just wanted to show you a sample of a utilization. We'd be happy to just dedicate a class to real estate investing, using your IBC policies, with a little bit more details around it. But any questions for Mike, or any comments or thoughts? Couture, I know that you and most of your clients are real estate investors. So we just wanted to kind of give a very quick overview. Any questions at all for Mike or for Curtis, or any questions in general before I bring back Joe to bring it all together for us?
I just wanted to shout out Amy Cole. Do you have a question? I know she's if she's still on, but she typically has questions. But thank you. Sorry.
No worries. It's all good.
Thanks, Couture. Yeah, I don't. I have something I want to look into based on his presentation, but thank you.
Okay, perfect. And again, based on need, right? Once you meet, the goal today is to give you the overview. Obviously, once you meet with your advisor one-on-one, and we can look at your specific from there, and we'll continue to put together specific training classes for each one of these areas, to help you, because learning will never end when it comes to IBC. You want to make sure that you are continuously learning and knowing how to maximize the system. So with that being said, Joe, if you can hop back on. I know you have a hard stop in 20 minutes. So I wanted to bring you back to bring it all together. We see your PowerPoint.
Yep, here I am. I was just looking for the button. It's got buttons all over these monitors. So I think you can see a picture of this gentleman named Rothschild who died in 1812. Why, how in the world can we learn anything from this guy? Um, you may have heard that the Rothschild family was the richest family who ever lived, maybe since maybe since Solomon. But the Rothschild family has controlled markets and banking and the treasuries of countries um, for 200 years, and they're completely under the radar. Nobody knows what this family is worth. They're probably worth $1 trillion, but no one knows because it's a private family. They don't have to put their balance sheet out for the public inspection. But look at what he said. Give me control of a nation's money supply, and I care not who makes its laws. So they make the rules, we'll play by them. That's, I think, what we've been talking about. And some of you guys know I just love drawing, even though I'm no good at it. And you can see my scratching, right? Control, right? This is all about control. You control your wealth, and you're going to have more freedom. So we have, and every single person who has spoken today has talked about the fact that we have money slipping through our fingers. We have money passing through our lives constantly and continually. We're among the richest nations on the planet, and maybe that's why people are so complacent about wanting to hold on to it, because they just know that, well, next year I'll just make more, right? And I think we've referred to Nelson Nash hopefully throughout this time today, because we want to honor him. I mean, he's turned my life upside down in a good way. And he said, and most of you know about Parkinson's law. I'm hoping that most of you have already read his book. Parkinson's law has three components that he listed in his book. There are a few more, but Parkinson's law says a luxury once enjoyed becomes a necessity. And I think about my heated steering wheel in my truck. I never knew that I needed a heated steering wheel 10 years ago, and now that I have one, I wouldn't give it up. I don't even like driving my wife's Mercedes because it doesn't have a heated steering wheel, right? A luxury once enjoyed becomes a necessity. Number two, work expands to meet the time allotted. You have a job to do. When are you going to get it done? The night before it's due, right? Number three, expenses rise to meet income, and you could expand that and say expenses rise to overcome income, right? You make 100,000, you're going to spend 110. You make 600,000, you're going to spend 700, right? And Nelson says if you can't overcome Parkinson's law, you might as well dig a hole, crawl into it, and have one of your friends cover you up because you're done, right? And I mean, we are the richest nation in America, and here we are looking at. I was looking at this short video last evening talking about the net worth of companies. So, can you see over on the left-hand side here? $1.5 trillion. $1.5 trillion. That's what Chase Bank, Visa Bank, Visa, and Amex are worth. $1.5 trillion. What's their stock and trade? What do they do? They only do one thing. They lend us money. That's what they're worth. Okay. That's what their equity in the company is. If you add up all the stock in these companies, it's worth $1.5 trillion. That's not their cash flows. Okay. That's their residual equity. And they have that money because we voluntarily, we, you and me and 300 million other Americans, we voluntarily carry these plastic things in our pockets. And I like to think about, you know, taking those cards and shooting holes in them. And so I did. I only use one card, which is pay it at the end of the month, period. No matter how nasty that bill is, no matter how big that balance is, it's paid at the end of the month. And rethink your thinking. Think about some of the challenges we gave you today. an old friend of mine, John Savage, who was a mentor. He died 30 years ago, and I still remember the things that he told me because I practice them to this day. This is not a get rich quick scheme. This is a get rich slowly model. This is not about you getting rich. This is about you getting rich and teaching your kids how to stay rich for only one reason in my mind. You could think of other reasons, but this is me. I'm not going to tell you how or why you should get rich. I believe that we should get rich so that we can do more good. Somebody said the definition of capital is the ability to do good. And the more capital you have, the more good you can do. So why are we letting these outside banks, these toxic lenders, control our lives because they control 35% of our cash flow? The friend who died 30 years ago, he says, I'm amazed that there are people out there who can't save half their income. Okay, I'm going to give you a few seconds to laugh at that because you probably know people who can't save half their income. And I'm telling you right now, I've made that a goal in my life to save half my income. And Nelson's challenge to us was to take 100% of our income and put it through our banking system. Imagine having all the capital that you need to finance your house. I'm not even saying, and Nelson wouldn't like this, I'm not saying you should pay your mortgage off if you have the money. I can show you how to pay it off and get the money back. See, that's the thing. I don't want you to use the friendliest creditors out there. I want you to be the creditor. I want you to control the asset and control the bank. Control the asset, control the capital, control the asset, control the debt. Is debt bad if you're paying the majority of the benefit back to yourself? If that debt is creating equity in your life? Of course not. Now, I may be mixing metaphors here, but the point is we need to get control of that wealth that's already existing in our lives. I mean, like Curtis was talking about. If you need more income, then go get more income. There's ways to do it, but don't give up on saving a portion of what you make now. And the reason why you can't is because somebody else has control of it. So at the end of the day, it's about control, and control will lead to freedom. You can't have freedom without control. I'm going to open it up. We've got a few minutes left for Q&A. If anyone has any questions.
Yeah, actually, if you see any on the chat, I know that there's a long list. I've seen that there have been multitude of them answered via the chat.
Yes, that's a beautiful sculpture. Yeah. Do we have any questions? I think we got. I
put them on there for a reason. I put them on there for a reason. So somebody asked Michelangelo. I'm waiting for questions. Somebody asked Michelangelo, how did you do this? How did you build that David? David's like 10 feet tall, and there are certain. I guess there are multiple copies of it around the world, but how did you make that sculpture? That's amazing. I mean, what a gift you have. And he said, I just looked at a block of marble and I just took everything away that wasn't David. Now, that means a lot to me because what we do in our helping our clients, coaching, guiding our clients is we talk about your cash flow map, like Curtis was talking about, your cash flow map, and help you remove anything that's not edifying to your life. I mean, we're not going to tell you what to do. I'm not going to tell you what you should do. This is your money. This is your wealth plan. But we'll make suggestions as far as what we've seen other people do that have worked to build up their wealth. And this should be a collaborative effort. I want you to help me. I want to grow. I want to continue to learn. I'm not done learning. You should never be done learning as long as you're still breathing. No, we should help each other out. I used to have a checking account that said Pantozzi Family Bank on the checks. Had a CPA tell me, you shouldn't do that because the banking regulators are going to come down on you for operating a bank within a bank. I changed the name of them on my checks to Pantozzi Family Fund. Small change, but it was something that protected me. And he helped me by making that suggestion. Now we make that suggestion to all our clients. So as we learn more refinements, more nuances, learning to use correct language, we're not borrowing from our policy. We're not taking money out of our policy. We're borrowing against our policy, right? We're going to suggest things for you to help you grow, to help you build wealth. We really want badly for you to teach your kids this. And that's why we want you to own the literacy. We want you to own the process, own the wisdom. Okay. Questions?
Do we have any questions, guys? Yeah, please feel free to ask any questions. I think everybody has the ability to unmute. Does anybody have any questions at all or anything into the chat?
I
Hey,
do.
I'm thrilled to end 8 minutes early. That's good. Yes, ma'am.
I do. I started to type it, but this is in reference to what would the Rockefellers do, and they talk about family offices and like having a family constitution to be able to teach this. I was just wondering if any of you have that, or like how are you actually teaching this to your family, Joe?
That's a great conversation to have for another session that should last a couple hours. I have a great client in Denver who really led the way on this, and he's been building his family constitution for the 15 years at least that I've known him, and that involves creating a statement of values, your family mission statement, your family vision statement, your family goals, your family values, what you guys treasure. I mean, for example, and you're a pup, so you're not a grandparent yet, right? You may not even be a parent yet. I'm a grandparent, and I don't want to leave millions of dollars to my kids and grandkids unless they have the skill to manage it, to be good stewards. And until I know what they're going to do with the money, because they're not going to get the money free and clear to spend it on themselves, right? So my family constitution is going to be embedded in part and parcel with my estate planning documents. My trustees, my lawyer, everybody around me knows how I want the money to be stewarded, to be marshaled, right? And that's something that you don't sit down for a couple hours and just write it out. You have meetings with the loved ones, with the people who are going to be the managers over decades and generations, and you build those values into your system. And yes, it should be written out. What is it I want to accomplish? If I have $1 million, $10 million, the amount of zeros doesn't matter. If I leave this earth with a certain amount of wealth behind me, what do I want done with that wealth? A, and B, what do I want to do with it now? Because I've challenged people with this all the time. Don't wait until you're dead to have your family carry out your wishes. Start doing that stuff now. You want to build wealth to do good, start doing good now. Set up your own family foundation, set up your own nonprofit, participate in the nonprofits that you're aware of, that you want to help. You have people around you, there are people in any direction who need help, right? Of any sort, right? Your family constitution is, who are we? Why are we on this planet? What do we want to accomplish? What do I want my obituary to say? What would be the good things that somebody could say about me? And I want to make sure that they are true, right? So I'm going to start working on making sure those things are true in my life, so that people could look at that afterwards and say, yeah, he's gone now. This is what his obituary says. And actually, I think it's true. I think it was true of him. So your family constitution has to do with not the dollars and cents. I mean, it can address those, but the primary thing is mission, vision, values, where we're going, where we've been, where we want to take our family, our generations, what we would like to see our great grandchildren know us for, remember us for. Will your great grandchildren remember your middle name? And why will that be?
That's good. Thank you.
You got any more questions?
Thanks to all of you for being here. I enjoyed it. I especially enjoyed learning from my colleagues who are really becoming professionals in what they do, and they are great speakers. Mike Stevens, you're amazing for delivering 85 pounds of dynamite in about 15 minutes. That was really awesome. If I could learn to be concise, I would be king. That's really good. Thank you.